ton of Fed speak this week, including today. Tom, I wanted to finish on this because I know you want to talk about it. Switch up the board and get to Europe. Euro dollar, the German 2-year, negative 64 basis points on a 2-year. Euro dollar 116.27. We need to talk about the resignation of President Weidmann of the Bundesbank. And Tom, for people familiar with the recent history of the Bundesbank, for me, Tom, this all started in 2011 when Axel Weber quit. From that point onwards, this Bundesbank lost its bite in a big, big way. Jens Weidmann might have made a lot of noise about what he thinks the ECB should do. The fact of the matter is, Tom, ECB policy is where it is because he didn't have the influence that some people in Germany might have wanted him to.
Let's stop here and go into this, folks. This is important. Long ago and far away, I looked at the TV screen and I said, what is that in front of the ECB building? And it was someone named John Farrow. John, what this comes down to is a Germanic central bank taken out by Weidmann, who was German, but with a massive French angle, a French education. John, from where you sit in your decade of watching the ECB, how cultural is this?
Well, Tom, there's been a shift, a massive shift over the last 10 years. And if you want the history of it, you're familiar with it. In early 2011, Axel Weber, the then chair of the Bundesbank, was the leading candidate to take over the ECB from Mr. Trichet. Tom, there was some real pushback that started to build up, and he resigned. He resigned. It was unexpected for the likes of Chancellor Merkel, who had just supported Vitor Constancio to be the vice president of the ECB. The idea being that the president's spot was open for someone from the core. Then all of a sudden you introduced President Draghi. And Tom, from that point, it totally changed. It totally changed. And the ECB was no longer just a reflection of the Bundesbank. It became something much, much bigger. That narrow mandate, Tom, it went way, way past that. And here we are today.
And I'll go with the research of Deutsche Bank led by David Folkers-Landau, the originality of negative interest rates. Are you done, John, or you got more?
I'm done. I'm complete. We can talk a little bit more a little bit later.
Let's dive into this right now, and we are advantaged with Julia Coronado of Macro Policy Perspectives. She is truly an academic of the Fed, working in market economics with the knowledge of Dr. Weidmann as well. Did he leave, Julia, would you suspect, because of the transition from Merkel to something new for the Republic of Germany?
Oh, yes. I mean, that was a very important inflection point for the Eurozone. And the appointment of Draghi, as Jonathan said, it changed everything. So I remember very well the existential moment that we were in at that time. I was working for a European bank, BNP Paribas, and we actually had a repeated series of existential moments. And Draghi turned out to be the glue that held it all together, in addition to Merkel's actions. But I think that was actually a very important transition away from the Bundesbank-driven ECB towards something more flexible that had a view and a vision to holding the Eurozone together.
The hallmark of your work at BNP Paribas, you were absolutely right about tepid GDP within that era. The reality for Germany is massive trade surplus, 200x billion, only China ahead of Germany, with a huge foreign component, and yet a domestic economy flat on its back. Does the new Bundesbank president have to say, let's get this domestic economy going, or do they not care?
I mean, I think to some extent they do need to say that. I mean, we do still need a demand driver in the Eurozone, although, you know, I think it's not quite as dire as where we were before. I mean, the Eurozone has weathered the crisis reasonably well, is in a pretty decent position. But yeah, I mean, Germany is in the same position that it's always been. It is a really key economy for the Eurozone, and it does need to help drive demand for the region.
Julia, the idea that one of the lone hawks on the ECB is gone raises the issue that we see more broadly for central banks, which is the pressure really is to not make a move, to not make a policy error, to not raise rates too soon. And yet the market in the United States is pricing in 2 rate hikes by the end of next year. What do you think it will take for the Fed to actually get to that place, given this pressure toward easy money policies for a longer time?
I think the main scenario that has to develop for the Fed to move to rate hikes that steadily would be that most of this inflation does turn out to be demand driven, that it really is reflective of a hot economy, a tight labor market generating strong wage gains, that the hawks are right about the labor supply not coming back, and that you really have these demand-driven incipient inflation pressures that are building and broadening. That is the only scenario in which rate hikes make sense as the solution to the problem. If instead most of this inflation, or at least a significant portion of it, is tied to chip shortages and supply chain bottlenecks that get resolved over time, the Fed hiking rates wouldn't do anything to fix that and would actually harm the broader recovery. So it's going to be really difficult to read these tea leaves. Luckily, the Fed has some time. They've set out a tapering schedule that's probably not going to deviate. So we're tapering from here to June. And then we'll see where we are by then. I think companies' earning reports are going to be a really important bellwether indication of how companies are navigating this, because let's not forget, one of the things that's been one of the narratives this year is that companies have actually been navigating these challenges surprisingly well and in a profitable way. And all the incentives are aligned for them to do so. We've been in a highly profitable, highly productive economy despite all of these frictions and challenges. Does that continue to be the case? Do these problems get solved and we hum right into 2022? That's not an unlikely scenario.
All right, so in that scenario, if you see the Fed staying on hold because everything's humming along, what's sort of the tipping point in terms of 10-year yields? I mean, if we keep humming along and the Fed remains easy, the expectation is for 10-year yields to rise. At what point is it unsustainable for an economy that has more debt than ever before?
Oh, I think we're really far from those levels. Where we are is, I mean, last recovery, we discovered through the ebbs and flows of yields that 3% was the magic yield on the 10-year that really started to hurt the economy, that really started to hurt the interest-sensitive sectors. And obviously, that might be lower now, it might be higher now, but we're certainly far from there if that is still the sort of magic number. So, we could probably see, especially if this rosier scenario turns out to be the right one, yields can rise, and it's just fine for the economy. It actually serves to naturally cool things off, like housing, which have been running super red hot.
Julia, should we pay attention to Atlanta GDP now? I mean, it's a wonderful methodology, great respect for the talent here and, frankly, the other regional banks that are guessing GDP. But do you find value in the vector of Atlanta GDP lower, or even the sub 1% number?
Yeah, no, I do pay attention to Atlanta GDP. They're not always right, but they have a very careful methodology that I understand. And so we're actually tracking 1.5% too. So, I mean, they're lower now.
Okay, well, I don't mean to interrupt because of time, Julia. I've got to interrupt here. If we have a sub 2% GDP, does that constrain the Fed in tapering and also in rate hikes?
Well, the problem with this number is it's all cars. It's all autos. It is all about the semiconductor shortage. So auto sales have plunged not because of lack of demand, but because of lack of supply. Inventories are down. This is also maybe constraining the construction sector.
So what's the real number? What's the real number? What's the real GDP number if it's car adjusted?
Well, I don't do that myself pre-GDP, but you can look at that number once the GDP number comes out, and it will be substantially higher. So domestic demand, we've seen retail sales be resilient. We've seen other service sectors remain resilient. The consumer is pretty resilient. The demand is pretty strong. So, I think ex autos, it's going to be a pretty healthy above trend gain. And we expect some, the beginnings of, higher production in Q4 to produce another decent number. We're at 4%. So we'll see. Timing these bottleneck resolutions, especially with the semis, has been maddeningly difficult. Every time we start to get production ramping up, COVID comes back up, another factory shuts down, and the whole thing, hits the brakes again. No pun intended. And so we're just watching day by day how things evolve on that production front. Now magnesium might be another bottleneck. So we'll see how all of these things evolve. But it's a wild ride. Given remember 2020 was all about how surprisingly resilient the economy was. Now it's all about how surprisingly unresilient global supply chains are. But again, incentives are aligned to fix these problems. So, and COVID, knock on wood, we're heading in the right direction. Hopefully the economy can move forward and those wheels can spin.
We're struggling to keep up still. Julia, thank you. As always, Julia Coronado there of Macro Policy Perspectives, just wonderful. Tom, last year, in the depths of all of this, we thought the Fed wouldn't be hiking for a long, long time, and here we are talking up 22.
To me, it's just a swirl right now. We need more data. John, magnesium out of Rotterdam. Thank you, Bloomberg. Up 335% since the end of last year.
There you go. TK.
Only we do that,
Lisa
John.
Kravitz and Jonathan
Only
Ferro.
we do that.
5-day winning streak on the S&P.
Magnesium.
Slightly negative today
I
from
can't
New York.
spell it, but
I bet. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. New York City will require all of its municipal workforce to get vaccinated against COVID-19, getting rid of the option for testing, according to Dow Jones. Mayor Bill de Blasio is set to announce an order today that would mean some 46,000 city workers need to get their first vaccine by October the 29th or potentially lose their jobs. The city already requires vaccines for educational and public health care workers. A bipartisan push to make the U.S. more competitive with China and bolster domestic chip production risks falling by the wayside as Congress faces its packed agenda. The Senate passed legislation including funding to strengthen the U.S. semiconductor industry, marks rare cooperation between progressives and conservatives, but Democratic infighting in the GOP feud threatens the bill and could worsen the chip shortage. Singapore is warning that COVID-19 cases are dangerously testing the city-state's healthcare, even as strict rules designed to curb the current outbreak are set to be reviewed. The Ministry of Health says new daily cases hit nearly 4,000 yesterday. That's a new record. Health officials say the number of people requiring ICU care is straining the hospitals. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm on.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Might it impact China's growth because it is already slowing? Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, port delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Do you consider yourself a filmmaker, a historian, an educator?
Well, the biggest thing is that I'm a filmmaker, and that means I tell stories. And the way a painter might choose to work in oil as opposed to watercolors, I choose to work in history.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Assuming it gets approved, we will be ready to provide this new formulation. It is a different formulation than the one that we are using for the adults. It's using 1/3 of the mRNA as a dose. And so we have done all the work to manufacture it at scale so that we will be able to provide it almost immediately.
The Pfizer chairman and CEO from New York City this morning. Good morning. Tom Keene, Lisa Brammitz and Jonathan Ferro. Your equity market with a lift over the last 5 days. 5-day winning streak into Wednesday. Slightly negative this morning, a half a point. Let's call it what it is, a flat market. In the bond market, yields going nowhere, 163.73 on 10s. In the FX market, euro dollar going nowhere, 116.31. There's a theme here, isn't there? In the commodity market, we go somewhere. We're negative 1% on crude to $82.04. That's the price action. Here's some of the news. New York City Mayor Bill de Blasio, saying that there will be a vaccine mandate for New York City's workforce, Tom, without a testing option. City employees to get $500 incentive check for the first dose. That news dropping in the last couple of minutes, Tom.
John, in the 70s, there was an argument around the dining room table over MMR, measles, mumps, rubella, and the answer was, well, it's not a big deal, people don't die, but actually they do die of measles. And in the 90s, with the courage of people like Bhakti Hansadi and the medical community globally and in America, we took out something like 70% of the deaths from measles. Now we're having a debate over when we get vaccinated. John, with those really critical headlines, we drive this conversation forward with Bhakti Hansadi of Johns Hopkins University. Bhakti, what took so long? To a lot of people, granted there's people that are not so much anti-science, but look, prove to me it's right, I get that. But to the pro-vaccine crew, all of this should have happened 12 months ago, 15 months ago. Why did it take so long?
I think politics and misinformation, quite simply. We politicized the vaccine debate. We provided misinformation, and the public was confused as to what is the right choice here. And there was no choice. Vaccines save lives. Everybody should take them.
We didn't have this debate with MMR. I remember some tension. I'll go with that a little bit, but nothing like now. Is it because of culture wars? Is it because of social media? Why did we do this?
I think it is due to social media, right? There's a lot of information out there. People don't really know where to look. On top of that, we mediatize, publicize every decision as being political, which leads to more noise. And with MMR, it was very simple. MMR is a vaccine. The vaccine prevents illness. Take the vaccine. That was all that was there. Now people, the modern consumer is looking at, how was this vaccine developed? How was the approval? How does this approval compared? What is this technology? I don't think half of us knew what an mRNA vaccine meant, and now all of us are well versed.
We're no longer talking about getting to herd immunity, Dr. Hansadi. We're talking about getting to a time when we see many fewer hospitalizations and many fewer deaths. And yet over in the United Kingdom, we are seeing the number of hospitalizations and deaths pick back up despite a very high level of vaccination. What's the latest school of thought in terms of the threshold of total population inoculated to get to that place where we really don't see this as such a present concern on a day-to-day basis?
The challenge with this concept of herd immunity is that it's a zero-sum game, right? That we get everybody vaccinated and the virus goes away. The truth is that the virus continues to evolve. We still get through breakthrough cases, and we have a greater proportion of our population who is immunosuppressed for one reason or another. In the UK, we really believe that this new peak is being driven by the lack of vaccination in children aged 12 to 15, and the school-going children are getting exposed and then bringing that virus home.
All right, so what's the latest on getting those individuals vaccinated? We have heard from the Pfizer CEO, they're ready to go. The FDA has basically all but approved this, so what are we waiting for?
October 26th is the magical date for the FDA advisory board. I think it will get approved. The CDC study already shows that it was 93% effective at getting children, keeping children out of hospitals, which is phenomenal. So I think there's lots of parents who are excited about this. I think the FDA will approve, and I think it's imminent. And pediatricians' offices are already midst of the flu vaccine campaigns. A rollout will be easy.
On a log chart, are deaths correlated with cases? We've got good news on cases. Bhakti, do you see a slope that is good news for deaths in America?
Yeah, I do, actually. I see that the deaths are actually teetering off. However, one of the challenges that we're now seeing in the health system is this lack of a workforce. So we're seeing severe nursing shortage crises around the country. And we are worried at what that does to individuals, not only those who are hospitalized due to COVID, but are hospitalized due to other medical conditions. So yes, there's a human resource crisis that's happening as well, which is complicating this picture, but we do see a decrease in deaths.
Doctor, thank you. It's great to catch up with you. Dr. Bhakti Hansadi there of Johns Hopkins. Tom, we do have to be careful with things like vaccine mandates. And the reason being, it's pretty clear in some of the data in a lot of this country that minority groups have been more reluctant to go and get a vaccine. They've been vaccine hesitant because they have legitimate mistrust of this government that's been built up over time, Tom. That's not a story unique to America. It's a story we see elsewhere as well. If you start to go forward with these kind of things, Tom, without making sure there's been sufficient outreach to those communities, there is a risk that they get ostracized from society, in restaurants in New York City, from the workforce in New York City. These are big issues.
The issue here is the calendar, and that, John, unlike most pandemics, this was almost too successful. We brought on these successful vaccines at light speed.
We
and
did.
To your point, we did not have the time to get the public ready for vaccination. I've emphasized that we completely failed at a celebrity buy-in, if you will. I mean, you take two people from the Super Bowl, John, or you take two people from the Premier League and you show.
Tom, but I don't think that gets it done. I don't think that gets it done. We're talking about the mistrust of government amongst minority communities, Tom, and there are legitimate reasons for it. And we're also talking about the mistrust of government from people that just so happen to vote for the former president, Donald Trump. But for some reason in the media in this country, it was the latter where all of the focus was. Tom, when I first heard about the vaccine hesitant in America on Facebook, it was upper middle class hippies on a West Coast in California, granola-loving people, Tom, who did not want to touch vaccines. That was several years before all of this happened. Did they go out and get a vaccine?
That's a different cohort. than what you're talking about.
But they dominated the boards on Facebook, and this has been a story, Lisa, that's been building for a long time, and we haven't done anything about it.
You raise a really interesting point, which is what's the best way to bring people into the fold who are not getting vaccinated? Do you allow them to have that choice to just not get vaccinated? Do you keep tightening the screws of the social dynamic to try to get them into the workforce as well as vaccinated? Or do you just say, to hell with it, you either get vaccinated and stay in the workforce or get out, and just let the chips fall where they may? It's a good question. The education point is key. How do you do both? Basically, what is the question with respect to tightening the screws while also enlisting people, saying it's safe, come on, we want you. It's not like we're trying to alienate you.
It's worthy of a bigger conversation. Tom Keene, Lisa Bramett and Jonathan Ferro, your equity market unchanged on the S&P 500, weighing it on markets worldwide. James Athey, investment director at Aberdeen Asset Management. From New York City this morning, we go nowhere in the bond market. We've been going somewhere in this equity market, 15, 20 points away from all-time highs in America, despite all of the doom, all of the gloom about what the future might hold. This is Bloomberg.
They know me as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for example, even 3 to 5 years, I think.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
There's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
idea that things are transitory is obviously wearing thin.
Investors will refocus on economic and earnings fundamentals, which will push stocks higher.
The Fed is saying from a monetary policy standpoint, this is just a matter of patience.
The Fed can't really meaningfully do anything by raising rates.
Markets are not comfortable with the idea that central banks are going to be dovish.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is the slow grind back towards all-time highs from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market totally unchanged on the S&P, Tom, after 5 days of gains. We're almost there.
I'm going to go to equities, John. I do want to say Jacob Kierkegaard in this hour on Weidman, the interview of the day. John, you're right about the equity markets, and I'm sorry, I'm looking at the earnings come in. I'll defer to Gina Martin-Adams, David Wilson, and our great equity strategists to come on the show. But to me, it's earnings glass half full.
That's the story in America. Let's talk about the story in China, Tom. Another developer hitting the wall. Chinese home prices, Tom, falling for the first time in 6 years. There's a real slowdown developing there.
Ear on the rail. I want to listen to Leland Miller and others about the real pulse of the Chinese economy. John, I'll be honest, I'm just simply confused.
Lisa, Tom's not the only one. We're all confused at the moment.
And not just on the slowdown in the housing market and potential defaults, but the ripple effects for the broader economy globally. Consider the fact that the housing market in China accounts for about a third of the overall economy. Yes, the smallest drop, but it shows a deceleration in one of the hottest spots in China's economy for many years.
When things get tricky, what do, Tom? You change your name. Do you see that report in Verge in the last 24 hours? Facebook, looking for a name change. I still Google. I don't call them alphabet, Tom.
Thank you.
Are you going to make the change with Facebook if they change their name?
I've heard like 3 reports, and I guess Horizon's where we are, but to me, it's the alphabet of Facebook's metaverse. What? Let's start with that. John, what is a metaverse?
You're asking the wrong guy.
I looked it up this morning.
Go on, Lisa.
Good,
it's basically the cyber world where people can interact and kind of create, the ultra zone. It's just everything social media and
you think this is divorced from the political moment we're in right now for this company?
You mean that they're not taking it that seriously?
No, I just think, do you think the name change is somehow connected to the fact that name right now is so charged, carries some negative connotations? No. Causation. Causation is not correlation, but in this case, yes.
Very good. Yeah.
Horizon. Give me a break. Equity markets flat this morning. Unreal. This Wednesday morning. Good morning to you all. Again, in a bond market, 163.55 on 10s. We go nowhere there. Euro dollar going nowhere too. 116.34. We go somewhere on crude, Lisa. That's where you get a bit of price action this morning. Crude down 1% and change. $82 a barrel on WTI.
Yeah, and talking about some of the confusion around China, this comes from them trying to clamp down on some of the higher commodity prices. How much of the crude decline is stemmed to that, is tied to that. We're seeing it in other commodities as well. And how long that can really last is a big question. Today, the Fed speak continues. It seems to be exhaustive this week. We have the Fed's Evans, Bostic, Bullard, Kashkari, and Quarles all discussing what they see as the economic outlook. I'm very curious to see what we've been talking about all week, which is the idea of tapering bond purchases and how that relates to raising rates. Christopher Waller, governor of the Federal Reserve, said yesterday, the rash of Fed speak yesterday, if my upside risk for inflation comes to pass, with inflation considerably above 2% well into 2022, then I will favor liftoff sooner than I now anticipate. How much does this gain steam among other Fed officials as the market prices in 1 to 2 rate hikes by the end of next year? 2 p.m. we get the Fed's beige book. Very curious to see what they say about supply chains. Also, we've been talking this morning about the Atlanta Fed's GDP now read, which has dropped to the lowest since July 2020. How much is this just due to the slowdown in the auto market versus a broadening out in some of the areas that have been affected by the supply chain kinks? And aftermarket, Tesla is reporting earnings. The share is up about 22% so far year to date. How much do they say about chip shortages? How much is this impacting production? And what do they say about China as a place for their factories, John?
I'm really looking forward to catching up with Dan Ives of Wedbush. Tom, in the next hour.
Yes.
I know you are too.
I was blown away by the new Apple announcements. The speed performance is shocking. Can we get Ives to raise his bull market call on Apple? I think we can accomplish that.
He's at 185 right now, Tom.
I mean, let's go. Let's top tick him to 199. I'll even get him out to 201. We need to accomplish that with young Ives this morning.
The Tech Bull joining us in the next hour. Looking forward to that conversation. Joining us now is James Athey, Investment Director at Aberdeen Asset Management. Just going through your notes, James. Here's a quote for you. that you wrote, so you understand it. The idea that central banks are making a policy mistake and therefore more hikes equals lower exchange rate, and that seems plausible in explaining price action. You go on to say it makes little macro sense. What do you mean by that, James?
I mean, it kind of depends exactly where you're looking, but broadly speaking, you know, the point I was making was characterizing an inflation targeting central bank engaging in tighter monetary policy from a stance which is as easy as history has ever known, on the basis that broad inflation expectation measures are moving higher and significantly above target. The idea that that is characterized as a policy error, yet 10 to 20 years of experimental and aggressive policy easing to try and deal with the mild disinflationary impact of a global positive supply shock, I find to be implausible in the extreme. So the idea that we should have currencies in developed markets behaving as if they were emerging market currencies and immediately ignoring the rate differentials argument and immediately looking to the potential for some medium-term growth downgrade, I just find to be somewhat self-serving.
All right, James. So going forward, given the fact that you see central banks as both the arsonist and the fireman, how do you sort of read the tea leaves as we get the rash of Fed speak today and throughout the week as we get ECB members talking on opposite sides of their mouths?
Yeah, really difficult to do, because obviously I'm yinging when the market's yanging, right? I mean, the market has been very, very febrile over the last 6 months. And if you think about the world in a very simple kind of 4-quadrant model with respect to growth momentum and inflation momentum, you know, we seem to be flitting from one quadrant to another on an almost daily basis as the market wrestles with some of these medium-term questions. You know, in your intros there, we've talked about inflation and a couple of talking heads talking about the transitory word. Just on that, I mean, I don't know the answer. I've said for a decade that inflation is poorly understood, and it's a woefully inadequate measure to be so central in our monetary system, in our monetary framework. But just on the transitory, you know, I've said before, I think on your channel, that we need to at least get past the first year-over-year comparison, because you know that's how base effects work. But you know, I was digging through the history yesterday, and in the UK we've had one CPI print over 3%. Back in 2011, we had 19 consecutive CPI prints over 3%, and that was a transitory inflation shock, shall we say. It was a bit more idiosyncratic. It wasn't global, but the central bank was happy to sit idly by. It did sit idly by, and they were quote unquote correct to do so. So framing transitory as meaning 1 or 2 months, I think, is disingenuous. And again, US CPI has gone sideways for 4 prints: 5.4, 5.3, and 5.4. So that just gives some context.
James, to your idea of arsonist and fireman, which I must say is brilliant and really captures the moment, is it because our central banks, and particularly the Fed, are trying to do too much that they've encompassed a new mandate that is broader and wider and social?
That has appeared as a narrative recently. Certainly Lawrence Summers has made that point, and I have huge concerns about the idea that central banks can unilaterally expand their mandates into areas which really are, you know, overtly political and overtly democratic issues, not unelected technocratic issues, but also well outside their competencies. So I do have concerns about that. I don't think that's why we are where we are. We are where we are because central banks have essentially taken it upon themselves to prevent any negative, any downside from ever occurring, and that is having additive and increasingly negative and nefarious effects on the economy, because we're not getting any creative
James, the question is, and forgive me for jumping in, is how sustainable that new stance actually is. They've had the space to do that over the last 10 years because inflation was so muted, so subdued, and I think what a lot of people are trying to work out is how durable that Fed put is in this new era. If that's what we're in right now, if this is a new regime, James, how durable is it?
Totally, yeah, absolutely. I think that's absolutely the right question to ask. I don't believe that central banks in general will be able to, it will not be credible for them to sit on their hands throughout this period that we are going through and that we're likely to be going through into 2022 and possibly into the second half of 2022. We're seeing that playing out now. That's why we've had this curve flattening view, because we felt that if the world progressed as market expected, it would inevitably put upward pressure on front ends.
James, got to leave it there.
The question.
Always great to catch up, sir. I'm going to give you a call. We're going to have a 20-minute conversation about it. James Nathy there of Aberdeen. Thank you, James. As always,
Aston
mate.
Villa?
About this, a bit of football, Tom.
Football,
a little bit of Netflix, maybe. That stock is down by 2% in the pre-market. 2% lower in the pre-market after a really nice run more recently off the back of the popularity of Squid Game. All about subs, Tom. 4.38 million subscribers in the third quarter. The estimate 3.72.
I've never been warm and fuzzy on this. I don't really understand the model. Paul Sweeney says I'm wrong. He says it's like a real model. There's some people out there today questioning it. I don't know.
Lisa, a pullback. Maybe those numbers validating where we've been instead of inspiring where we might go.
All right, I have to confess, I was a naysayer of Netflix when they were raising billions and billions of dollars and were not posting any profits. They are moving to free cash flow positive and see themselves being free cash flow positive for the foreseeable future. And I find that really interesting. Their story is actually borne out. Yes, it's down 2%, but the stock is up, what? Almost 100% year to date. It's not like it's been suffering. We've seen a massive run. And the fact is, yes, they saw the lowest subscriber growth since 2016. But we did see an acceleration that surprised people. I'll just put that out there.
Just to be clear, was that a bullish take on the pricing of the credit market?
That was a realistic assessment.
Just, validating how that credit was priced previously.
Yeah, well, and basically, people were viewing it as a junk credit. Now they're viewing it more as investment grade.
Just to be clear, the stock up 18%.
Oh, year to date? Oh, sorry.
Just to be clear, just in case people really get run away with the idea of how well Netflix has performed. Details matter sometimes on this show. S&P 500 futures unchanged, 5 days of gains. We need to talk about a vacancy at one of the most influential central banks in the world in economic history. It's the Bundesbank. We're going to talk about that next. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Facebook is planning to rebrand with a new name that focuses on the metaverse, according to The Verge. The original Facebook app's brand may remain unchanged and could be positioned under a parent company with Instagram and WhatsApp in its portfolio, similar to Google's structure with Alphabet. CEO Mark Zuckerberg is expected to discuss the change at the company's conference next week. Now, Jamie Dimon has told staff JP Morgan will boost pay for its wealth advisors. According to Bloomberg reporting, the JP Morgan CEO dialed in from Windsor Castle before a meeting with the Queen to announce a revamp to the pay structure. The changes aim to encourage advisors to stick with the bank. Morgan Stanley says it will be SpaceX, not Tesla, that lifts Elon Musk to trillionaire status. SpaceX currently makes up less than 17% of Musk's more than $240 billion net worth, but Morgan Stanley has a $200 billion bull case valuation on it. Analyst Adam Jonas sees SpaceX as multiple companies in one, pointing to infrastructure, Earth observation and exploration capabilities. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Natanggap ko po ang inyong nominasyon sa akin bilang kandidato sa pagkapangulo ng Republika ng Pilipinas. I am a fighter, and I will always be a fighter inside and outside the ring.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Is inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We, for decades, have relied upon just-in-time delivery, and now we're beginning to find that there are real vulnerabilities. What the economy really needs is less red tape, less bureaucracy, greater flexibility given to the private sector to ease the supply chain, obstacles that we are seeing.
Elaine Chao there, the former U.S. Transport Secretary, catching up with Caroline Hyde at the Milken conference taking place on the West Coast right now. From New York City, here on the East Coast, alongside Tom Keene, Lisa Abramovich and Jonathan Ferro. In your equity market, there we go, unchanged. In your FX market, unchanged. Euro dollar 116.33. Bonds, might as well say unch as well, Tom. 163.38, unch on a 10-year. In the commodity market, $82.03, negative about 1%. So Jens Weidmann is a goner at the Bundesbank, Tom. He hands in his resignation. This comes from Capital Economics.
Please.
Whereas Weidmann's Bundesbank has often been at best a reluctant supporter of the consensus, this provides an opportunity for Germany's policymakers to move further into the mainstream. Just a take from Capital Economics, Tom, earlier this morning.
The history we have of this, folks, is Bloomberg Surveillance tries to get you the qualified voices on any of these topics. I want John to drive forward this conversation with his European Central Bank heritage, and we do it this morning with Jacob Kierkegaard. To say he's senior fellow at the Peterson Institute doesn't describe his definitive work on European defense and also, of course, on Germany and their central bank. John, why don't you kick it off?
Well, let's start with the vacancy at the Bundesbank now, Jacob. Your first takeaway, please.
Elections matter. I mean, this is going to be the first non-political appointment that the new German government will make, and he has a chance to in a situation not dissimilar to what we're going through in the United States right now, to put his own team. But I would also say that I think it's likely that we will have to, you saw that the dollar-euro was unchanged. So this isn't going to have a massive, dramatic, immediate impact on ECB monetary policy or such. Because
be honest, Jacob, just a quick question. Does your son work for the Greek government? Is that why he's so happy this morning?
I have my own in-house box here, as you can see. They're very difficult to suppress.
Jacob, do you have your son learning 4 languages as you speak? I mean, how are you handling that in the house?
I think we're on 3 or 4.
Okay.
Obviously, he doesn't. No matter what language I use, get out of here. He clearly doesn't listen.
That's what we like to see.
Jacob, if he comes back, we want his view on the ECB. Whilst we've still got you, I want yours. What's next for this ECB if this Bundesbank and its influence on the European Central Bank could change a little bit?
Well, as I said, I don't think it's going to be a big difference, actually, because, yes, Jens Weidmann has, at least earlier in his career, been a rather obstinate minority hawk. But I think, in more recent years, and certainly during the pandemic, he was in many ways, loyal team player. So I don't think it's going to make a big difference. But on the other hand, if you get another, high-profile dove, for instance, or something like that, well, then you would have a very strong axis between, say, Christine Lagarde and a Bundesbank president that would share many of her views and the views of the majority on the executive board. So that going forward, this is, of course, an opportunity to cement the current Lagarde consensus, if you like.
Right.
But immediate changes, no, I don't see many differences.
Well, Jacob, let's cut to the chase here. And again, John's expert on this. I'm not. What I'm hearing from you is, say, Isabel Schnabel, someone like that, clearly qualified, clearly with a dovish tilt, comes in. That's removed from the Bundesbank we know. What do the German people want? Do the German people want Axel Weber or Ottmar Issing, or do they want Dr. Schnabel?
No, I mean, again, I think the election result last month was very clear. German, they voted for an activist fiscal policy, and they clearly have a chance, he has a chance to give it to them. And the reality is that, one of Isabel Schnabel's great contributions at the ECB was to make change the domestic German debate.
Right.
And she will obviously be in an even greater position to do that while at the Bundesbank helm. So if the German government chooses to do that, I think she would be very good at that.
There we go.
That opportunity.
Jacob, let's just let him say. Come on, just let him say hello. Jacob, we've got to let him say hello. Is he an Arsenal supporter as well?
He is. He clearly only watched the last couple of minutes of last night's game. That's also very clear.
Jacob, we demand, Jacob, that you are nice to him. If you're going to put him in a timeout chair, let's not have it be a Germanic timeout chair. I want something more sensitive, like a Danish timeout chair.
Hey, Jacob, thank you, sir.
I'll give him a pit.
We're going to let you run and deal with it all. Jacob Kirkwood out there, fantastic, sir, as always. Arsenal supporter. And just fantastic on
John,
you.
What's great about this is we're going to have, when we get through this horror, let's be serious about it, this pandemic, the deaths, including General Powell, when we get through this, we're going to have a highlight reel of kids.
Yeah, let's be clear here. That moment, not unique to Jacob. Lisa spent pretty much every morning at home doing this, Tom, getting hold of kids and putting their hand around their mouths.
True story. When I was broadcasting from home, the kids would wake up and they would eat their waffles with Nutella on the couch watching me, and I would try not to watch in front of me, and occasionally they'd be like, hey,
is that why you got more gloomy?
Yeah, it got me really gloomy. I will say that a lot of people are getting sick of working from home, which is why you are seeing people actually enjoying going back to the office sometimes.
On a very serious note, on the ECB, Tom, what Jacob was alluding to there is the influence of Jens Weidmann on this ECB wasn't that great. So his exit is less consequential. It really hasn't held the European Central Bank from too much at all. And I think you can see that more generally in the policy of the ECB, with rates where they are. Rates aren't where they are because ECB President Jens Weidmann, or rather Bundesbank President Jens Weidmann, wanted them there, Tom. The balance sheet isn't where it is because Jens Weidmann wanted it there. It is because Draghi helped set the path, Tom, to take it to where it is today?
I would suggest, John, that it's still a theory waiting for a solution, and that the idea of a fixed currency among all those different countries and the benefit, the Germanic surplus of trade, John, is
Tom,
still the common feature.
It's the irony of the last 10 years has been the opposition of many people in Germany to the policy of the ECB. A major exporter got a much, much weaker euro than they otherwise would have got, and they've got deeply negative interest rates that was just a gift to say, go out there and invest in your economy. Yeah. And Lisa, they didn't. And I keep going back to this point with Chancellor Merkel. I do wonder how we'll look back at her tenure from an economic standpoint in 10 years, looking back 10 years, and whether that was successful or not.
And whether they actually exercised the benefit of those negative interest rates, right? Why haven't they borrowed more? Why isn't that fiscal plan that much bigger, since they have the leeway to do that? And is it really supported by the public? How much will the new Bundesbank kind of lead that charge?
Ask Matt Miller about the infrastructure in Berlin and beyond in Germany.
He's scathing. Yeah.
Ask him about it. Ask anyone that lives there. That was a gift. Go and invest.
Yeah.
Didn't happen. Tom Keene, Lisa Abramovich, Jonathan Ferro, your equity market unchanged. 5 days of gains, just a whisker away from all-time highs. We'll break down the price action for you very shortly from New York. A beautiful morning in New York City. This is Bloomberg.
Of the Greek economic debacle. What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms. And I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Unchanged in your equity market this Wednesday morning. Good morning. We are unchanged on the S&P. We're down about a point. On a Nasdaq, we're unchanged. We're down up about 5, up by 0.03%. On a Russell, we're negative 0.2%. That's the story for the equity market. The story in the bond market equally as boring. If that's what you want, maybe it's not boring. Maybe it's something quite nice for you. 163.73, unchanged on 10s, on 30s, up a basis point to 2.1%. Let's call it 2.1, Tom. We're really not doing much there at all. On a 2-year, as I've said repeatedly, we've basically doubled over the last couple of weeks, so just short of 40 basis points now. Unchanged there, basically, too, Tom. Where we are moving, this chart right here. I want to finish on this. If you're listening on radio, it's a simple one. House prices in China have started to roll over. They are negative for the first time in 6 years, Tom. The first time in 6 years. And you have to pay attention to that because the world's second largest economy is starting to slow. Developers in a country are starting to hit the wall, default after default, and house prices are starting to head in the wrong direction. And when these things start to progress, Tom, you get that snowball effect. Where does it stop? It's a big part of China GDP. The likes of Bank of America, Savita Subramanian, talking about the importance of what's happening in China for EPS on the S&P 500. I think it's worthy of a bigger conversation.
Yeah, the bigger conversation is cultural as well, John. It is the avenue for investment for the Chinese middle class. In Beijing, they're acutely aware of this. It's not just about, you know, the math of it and the investment and the financial. It's the behavior. This is where the Chinese people put their money.
I'm still looking for that chart, Tom. I have no idea if it's going to...
It's there. It's good. I like it.
There it is.
There it is.
There we go. That's
rolling
helpful.
over.
Tom, back to you.
70 cities. There's China. Thank you so much. On radio, a chart from the upper left to the lower right, as Mr. Gartman would say. Right now, Jim O'Sullivan with us. He's Chief U.S. Macro Strategist at TD Securities. Jim, I want to piggyback on what we heard from Julia Coronado earlier this morning with Macro Policy Perspectives. She thinks the auto industry is so messed up that she's literally partitioning American GDP for what we get, and then she's adjusting for a beleaguered auto business. Are you doing the same?
I mean, there's no question that auto is an extreme case. I mean, you can talk about the growth side, you can talk about the inflation side, but obviously, particularly on the inflation side, so much of the net pickup in the inflation numbers that we've seen has come from vehicles, particularly used vehicles, which, I mean, of course, that's a fallout of the semiconductor issue. So, yeah, no question, that's a big part of it. We saw in the industrial production report, of course, earlier this week that auto production was down again. I mean, there were other factors in there, too, Hurricane Ida fallout in particular.
Yeah.
But, yes, autos is certainly a big story here, absolutely.
Are you able now to get beyond into Q1 next year, Q2 next year, with a tone of optimism on GDP, or is it a vector down to potential GDP of 2%?
Well, I mean, our forecast is that, Q3 right now, we've got 2.5. And I mean, it looks like, if anything, the numbers are adding up a bit weaker than that. I mean, even if it's not quite as weak as the Atlanta Fed number, which has dropped below 1. But certainly the Q3 numbers have been slipping. Now, how much of that is Delta, which should be fading as you get into Q4? How much of it could be supply constraints, which may not go away quickly? And then how much is just the fading of fiscal stimulus, which we think is probably the big story over the next year as fiscal stimulus fades and growth decelerates, and the big surge in demand that we've seen that's been lifted by fiscal stimulus fades, and that helps ease the inflation numbers. So it's not clear what all those are, but we are counting on growth reaccelerating a bit. We've got 4% for Q4, but then 3%, so not a whole lot better than potential in Q1 and Q2, then down to 2% in the second half of the year. So, I mean, there's a lot going on between COVID and supply shortages and the fading of fiscal stimulus. But yes, we do think that growth is going to decelerate meaningfully by the second half of next year.
Jim, we've been talking for years, for months, I should say, about how difficult it is to get both the macro call right, the economic call, as well as the market call. At a point when so many people are expecting a deceleration, what will it take for that to become bearish for a market that wants to go up, that is going up despite some of these concerns?
Well, I mean, the question is, I mean, how much deceleration, of course. I mean, if it's enough deceleration and unemployment is still edging down, I mean, inflation isn't forcing the Fed, and that the cycle is continuing, then, I mean, that can be good generally for risk markets. So, yeah, I mean, I mean, if it slows too much and you start getting zero type numbers and people start worrying about the cycle again, that's a different story. I mean, in our forecast, rightly or wrongly, the growth slows, but I mean, certainly the recovery continues. We still continue to get pretty solid number by pre-COVID standards, not the kind of numbers we've been seeing over the past year plus. But ultimately, the cycle continues. It gives the Fed some time before they actually have to pull the trigger on rate hikes, although they're clearly going ahead with tapering next month. But yeah, absolutely, it's a fine line. And of course, there's a lot of uncertainty, and you see how much the world can change in 2 months.
Yeah.
And predicting out a year is very hard.
Well, Jim, we were talking yesterday about the Bank of America Fund Manager Survey showing a real bearish sentiment on growth, this idea of the deceleration that you're talking about, but a very bullish stance when it comes to equities. And I do wonder, from your perspective, whether this is actually Goldilocks, whether the deceleration is actually exactly what props up equities, and to view these as contradictory signals is actually faulty.
Yeah, no, I mean, it's a pretty optimistic sort of fine line that's being drawn there. Absolutely. If growth doesn't slow as much, I mean, there's a big debate, of course, right now that we see clearly fiscal stimulus directly is poised to fade significantly. The deficit is going to be down pretty sharply in fiscal 22 compared to 21. So much of the COVID stimulus was front loaded into 20 or 21. The counterpoint of this, of course, is there's so much excess savings that people are going to spend over the next year. I mean, we think the net of that is negative. But I mean, hypothetically, it could go either way. And if you think the economy is still going to be booming in the next year, then clearly the Fed's going to have to rush tightening. I mean, alternatively, if the fiscal drag dominates and there's not that much delayed spending from excess savings, then the economy could weaken a lot more, and the recovery really stumbles. So, I mean, a lot can go wrong there, absolutely.
Jim, a lot can go wrong. Great. But the answer is we need to get a bearing here on what kind of economy this will be. You've got a shelf full of guessing out 6 months. Are you able to do that now? I mean, seriously, we used to guess out 3 years. And where we are now, does Jim O'Sullivan, with all your trophy taking in market economics, can you get out 6 months?
I mean, we obviously have to put numbers down, but realistically, there are so many moving parts here. And again, I go back to fiscal drag on one side and these excess savings on the other. And COVID is not gone away. I mean, the Delta wave is coming down again. But is that the end of it? I mean, there's a lot of uncertainty here. So, yeah, I mean, I think it's hard to have very high conviction on where we're going to be in 12 months' time.
I mean, Lisa, I think this is so important, is that I remember when, people said there and they got 24 months from now, it's gone. I mean, there's no other way to put it, Lisa. It's just gone.
The visibility is really diminished dramatically. And Jim, I do wonder how the labor market does play into that at a time when people are trying to head back to work. We just experienced what happens when you are not working in the office, when you're working from home with younger kids. I'm wondering what you see as the main obstacle keeping workers from getting back into a labor force that has seen more job openings than ever before.
Yeah. Well, there's no question COVID's been a big factor. I mean, I think a lot of people are still afraid to go back. I know there was disappointment with the participation rate the last 2 months, even though unemployment benefits started to expire. But of course, that coincided with the Delta wave. So that's certainly a big factor. But I think between COVID, between all the stimulus that's put in place, the generous unemployment benefits, I mean, all these factors, I think, have contributed to holding the participation rate down. But we do think over time, the participation rate will come back a lot more. It's not going to come back overnight. But in a year's time, I mean, the participation rate should be a lot higher than it is now, we would say.
If that's the case, at what point does it become a wage inflation story that we have to pay attention to?
I think in general, certainly for the Fed, I mean, of course, they've bought themselves time to some extent with tapering. I mean, it's pretty clear they're going to be tapering starting probably after the next meeting, and that's expected to wind down around the middle of the year. So they're doing something at least till the middle of next year. Now, that gives them the option of acting as soon as the Q3 of next year, which we think is way too soon. The market's pricing in, but it's an option if it comes to it. But as you get in toward the middle of next year, and the inflation numbers are not slowing and the wage numbers are not slowing, then clearly the Fed is going to be under pressure to act. But yes, we would expect the wage numbers to slow significantly in the first half of next year. I mean, if you're running 4 to 5% on wages still, based on average hourly earnings at least, then that's unsustainable over the long haul. I mean, we can probably sustain something like 3.5% or so, just given long-term productivity trends. But yeah, I mean, if you're getting kind of 4 to 5% on wages in, I'd say, even 6 months' time, that's going to be too much.
Hey, Jim, thank you, sir. Jim O'Sullivan, TD Securities economist. Tom, a world-class forecaster. Jim O'Sullivan is, on the labour market particularly. But this one is so hard to forecast now. It has got so much more difficult to read the tea leaves of this economy.
I wonder if you're going to hear this from the Fed speakers, John, this idea that Dr. Coronado brought up here of an adjustment for what Detroit and the greater auto sales are doing. I note Peter Bookvar mentioning Japanese auto sales just as tepid, again, because of semiconductor issues.
You know the one to call, Matt Lazzetti at Deutsche Bank, Tom, he's got a call. Back end of next year, this Fed's going to move.
Yeah,
that's the call from Deutsche Bank now. Rate hike is coming.
The rate, you know, and again, we have to adjust to what we see coming in. But I guess based on what I've heard from the pros, maybe you do adjust Atlanta GDP now to be not so gloomy.
Matt Lazzetti is going to be joining us very shortly. Lisa, Matt Lazzetti is not alone.
No, in fact, this is actually the base case priced into markets, and you could argue whether this is just hedging activity or real. But nonetheless, at what point, and you asked this earlier, John, it is a good question, which is at what point is the Fed's hand called by inflationary impulses that continue to run hot? And also, what does that do if they do raise rates? What does it actually materially affect the inflationary outlook?
I like the distinction you made there, the difference between trades going on and trades coming off.
Thanks.
That's important. That's
no,
all
it's,
right, you know,
thank you. I appreciate that.
Team effort,
She's
isn't
a
it?
thanks. Yeah.
You know,
Kumbaya.
that's what it's about. It's not what we're singing. It's that this.
We're singing.
You hold hands.
With arms in arm from a distance.
That doesn't work for us, does it? All right. Equity futures unchanged. Euro dollar unchanged. The bond market unchanged. That's your Wednesday morning. Chairman Powell Friday. That's what we're building up for now, and a ton of earnings in between. From New York City on radio, on TV, Tom Keene, Lisa Abramovich, and Jonathan Ferro not holding hands. Sufficiently separated.
Not kumbaya.
Tom's case with a glass.
Now that I think about it, John, we have never had a photo taken together. We need to do that.
You know what they do with us, Tom? You know what they do with us? They take 3 separate photos and then put us together.
No way.
We won't be in the
we
same
should
room.
all have one together on a bench in Central Park.
Just saying. Just saying.
I'll sit at the end of the bench, John, so I don't talk to you.
Thank you, Tom.
Thank you.
From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. A U.S. congressional committee investigating the January the 6th riot at the U.S. Capitol has voted to recommend the House hold former Trump administration advisor Steve Bannon in criminal contempt. Bannon has refused to testify or provide documents to the committee. The chairman says the House is expected to refer Bannon to the U.S. Attorney for the District of Columbia for possible prosecution. Now, Netflix has posted its strongest subscriber growth for the year, beating estimates thanks to the popularity of South Korean drama Squid Game. The company said it added over 4 million subscribers in the third quarter. It expects to sign up 8 million more in the current quarter while turning cash flow positive next year. Gucci sales growth slowed in the third quarter after COVID-19 resurged in parts of Asia, putting more pressure on the label's new collection to deliver a strong holiday season. Sales at the Kering-owned brand rose 3.8% from a year earlier. That compares with growth of 8% in the second quarter. Activision Blizzard has reportedly fired 20 employees in a bid to clean up its culture. The company has faced accusations of gender-based discrimination and harassment. In August, hundreds of staff protested after management dismissed a lawsuit describing a so-called frat boy workplace culture. The Financial Times says the game maker will expand its ethics and compliance team. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did
I
he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Do you consider yourself a filmmaker, a historian, an educator?
Well, you know, the biggest thing is that I'm a filmmaker, and that means I tell stories. And the way a painter might choose to work in oil as opposed to watercolors, I choose to work in history.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The recovery's been a little slower in New York, but with these flights that we're adding, plus what we've added and announced up in Boston in the last few weeks, the Northeast actually is taking a big step up into the fall and winter season. I'd expect by next summer, we're going to be back pretty close to a full schedule here in New York.
I heard some of that last summer. That was Ed Bastian, the CEO of Delta Airlines, Tom. We've just got to hope that this time around by next summer, that's true. But on the business cabin, Tom, I do wonder whether the business cabin fully normalizes in the way that these guys would like it to.
Part of its price, I've been looking at the ratio, John, you know, for family travel of business versus economy, and it's an outrage. I mean, it's like 6 to 1.
Yeah, and always has been, Tom, the front of the cabin subsidizes the back. That's just the model.
Yeah.
What it looks like going forward. Didn't we have a conversation last week about more premium economy seats?
Yeah.
In some of these cabins?
Like that.
Yeah, maybe that's the way forward.
I flew economy down to the IMF World Bank meetings. My producer was in the front row, and I was in row 36.
You weren't bitter about that. Was the plane busy, Tom?
One plane was busy and the other less so. The other one was good because I was with the marching band from Bethesda, Maryland, and they were actually playing, you know, during the flight.
What were they playing, Tom?
They were. I couldn't hear because the tuba player was right next to me.
That makes sense. Tom, just to check in on the price action. We're trying not to laugh.
Give me some price action.
The vision of you sitting there with someone holding a trumpet.
Playing it.
Well, yes. I had the ILC, which is
Equities down 4, negative, almost a 10 to 1%.
coincidence.
Just a touch softer here. Yield's not doing much. 163.73 on 10s, unchanged there. In the FX market, unchanged too. Euro dollar 116.28. Crude, Tom, dropping back, negative 1%, 82.14 on WTI.
For the gloom, trying to reset 15.72 on the VIX shows the good number of days we have had. Daniel Ives is going to join us. This is going to be an important interview on Apple and on Amazon and the rest of them, Tesla and the rest. David Wilson has the courage to look at Cheerios, and I would know Cheerios is trading at a 16 multiple. If you don't know what that means, all you need to know is Cheerios are wicked cheap. David?
Right. They're not so cheery, you might put it that way. Or you could look at Procter & Gamble and say that the company in its peer group, as the chart says, have been pounded and grounded. We're talking relative terms here. When you look at the S&P 500 Consumer Staples Index, and it's food, beverage, tobacco, as well as household products.
General Mills and the rest.
Exactly. You are talking about the lowest index value relative to the S&P 500, so it's a ratio, since January 2001. So we're not quite back to the lows that we saw in the dot-com years, but we're moving in that direction. And, P&G yesterday, I mean, talking about how its costs were going to be even higher than they'd anticipated because of what's happening to commodities and what's happening to freight.
Not your opinion, but within the research you read, are they a value trap?
Well, that becomes the question because, you're talking about a group that historically hasn't been all that expensive in relative terms. You're talking about a slower growth kind of area, no matter which segment of consumer staples you look at. So you wouldn't necessarily expect to see the kind of valuation you would on technology companies that are growing much faster. Nonetheless, the question is the gap, in essence, as it's reflected in the relative performance of the group when you look at the S&P 500.
I will say, Dave, when we talk to a number of investors, they point to this and they say, it's time to start looking to buy. And they start saying, we can look beyond the supply chain disruptions and we can take a look at the fact that their sales are still going pretty strong. I take a look at Nestle, for example, which came in showing revenue growth, even as they saw margins compress, optimistic for the future. How frequently do you hear buy the dip in some of these consumer staples versus the pessimism of ongoing supply chain shortages?
Well, not all that much, frankly. And what I've seen a couple of charts of lately are consumer staples versus that consumer discretionary category, retailers, automakers, home builders, and analysts pointing out that if you look at the ratio of those two groups, it's setting a new high. And they're looking at it as an indication that people are more willing to take risk in stocks. So until you get past that mentality, perhaps, you have to wonder what happens with the consumer staples in terms of any kind of a comeback here.
Dave, before we let you go, when we talk about the narrative of the market, earlier this year it was dispersion. It was looking at beneath the surface of the headline number and seeing a lot of churn. How much has that changed as the months have ground on and people kind of get a sense of what the macro backdrop is?
Well, quite a bit. I mean, I had a chart out the other day looking at the third quarter and pointing out that you had the narrowest dispersion among the 11 main industry groups in the S&P 500 that you had seen going back to when they were created in the late 1980s. So, the issue is how much has that changed? And, you kind of have to get through earnings season, perhaps, till you see how much dispersion there's really going to be. Because we've seen reactions to results going both ways, but not the sort of extreme moves that would really suggest that there was a big gap between the winners and the losers, you might say.
David Wilson, thank you so much. Greatly appreciated today. John, what's so important, and you've mentioned this, is the massive discontinuity between individual company ups and downs in the index reporting. I mean, the rotation here has been not so much historic, but original.
Yeah, Morgan Stanley on top of that, Tom. The stat I've mentioned quite a few times in the last couple of days, 88% of S&P 500 companies have had a 10% drawdown this year. The index, max drawdown, 5%. Apple reporting earnings month end, Tom. Let's sell it forward. October 28th. Right now, the most bullish on the street. We've got Ivan Feinseth at 198, Atlantic Securities at 190. Dan Ives isn't the big bully he used to be.
Slacking away.
At 180. Dan Ives is going to join us a little bit later on at 185.
That's important, John. I mean, everybody's coming up, ratcheting it up off different news flow and different news stream. We'll do a market cap. You really want to stay with us, folks, for this conversation because we'll frame out the trillions, if you will. John, did you see that Amazon and Apple are going to invade Los Angeles and take massive amounts of square foot real estate in LA to go into the entertainment business? I don't know. They're going to do, Apple this and Amazon that.
Okay, that's helpful. Lisa, any details on that?
I just want to give you this detail. Remember yesterday how we were talking about the $19 cloth for Apple's new polishing product? Hold on a second. It is sold out until November, so that you can't even order it if you want to. So when we talk about who would pay $19 for an Apple cloth, it turns out quite a people.
Well, that's why they did it. They knew people would. That's what I think is ridiculous about it.
I mean, there you go. Talk about margins.
Honestly, you need new chargers.
John, it's a polishing cloth.
Is that what it is, Tom?
It's a polishing
cloth.
You can use it for many different purposes.
I'm sure you can. Okay. Equity futures down about 0.1% on the S&P. Bit of a snooze, I've got to say, this Wednesday morning. We had all that hype at the front end of the curve with yields picking up. And then this conversation about higher interest rates kind of fades to the background as yields head in the other direction. 10 settling down at 163.55. Euro dollar settling down just a little weaker by 0.1% at 116.25. The doom and gloom not quite captured by earnings season just yet, Tom, but maybe the big industrial companies where you'd expect it to shine a bit more brightly haven't reported yet.
Yeah, we got a lot more to come. David Wilson with his great leadership on that. I would mention John Dover, not a big company, but nevertheless Dover may be indicative of some of the surprise we could see in the industrial cyclical area.
They're handling the pressure and margins are looking better. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro, heard on radio, seen on TV, your equity market 15, 20 points away from all-time highs in America. Just an unbelievable turnaround. We were down 5%. Who bought the dip? You bought it well. We're doing okay. This is Bloomberg.
I'm in cash.
They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
It's such an interesting new world.
The world is changing. For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging. We feel like we can maybe help people out more.
We have an enormous number of big ideas.
There's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal. to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The idea that things are transitory is obviously wearing thin.
Investors will refocus on economic and earnings fundamentals, which will push stocks higher.
The Fed is saying from a monetary policy standpoint, this is just a matter of patience.
The Fed can't really meaningfully do anything by raising rates.
Markets are not comfortable with the idea that central banks are going to be dovish.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Brownson, Tom Keene. In this hour, do you have the courage to be in the market? Beata Kerr with us in moments from Bernstein. Dan Ives with us on Apple to the Moon. John, equity markets, a mystery. Earnings, not bad.
You know what the big mystery is, Tom? Just how divorced the conversations we have every single day are from the price action. When people come on the program and talk about stagflation, we don't subscribe to that story, of course, but you've got a bond market at 164, Tom, on 10s. When people talk about the doom and gloom of margins, you've got an equity market just short of all-time highs. It's getting harder and harder to reconcile the conversation we have, Tom, daily on programs like this and where the market is.
4 or 5 days in a row in a pullback today. It's a crushing negative 0.03%, negative 0.07%. I mean, John, there's a bid there, whether it's buy the dip now or even what we saw in the gloom 10 days ago.
And that's been a story for 10 years, Tom. Every time there's a pullback,
fair.
There's a bid.
Yes.
We need to talk about the durability of the so-called Fed put and how durable that Fed cut can be if we've finally broken out of this low inflation regime. I think that's got to be the number one issue, top of mind for pretty much everyone worldwide right now. Does the Fed have the capacity to keep supporting an equity market if we break out of a low inflation regime that's dominated the economy for the last 10 years?
And Lisa, we heard it on deposits from the major banks. The wall of money out there, however you want to measure it, it's still there for the bid.
Well, it's still there, which is actually creating a bit of a conundrum for economists. Why isn't it being spent faster? And there was a Deloitte survey showing that the greatest number of individuals in the United States surveyed were not planning to buy Christmas gifts or not planning to buy holiday gifts this summer, this winter. The idea here of the K-shaped recovery is still very much in the forefront, but not necessarily affecting the trajectory of the economy, and certainly not markets in a material way.
Lisa, not much on Washington in this hour. Let's touch it right now. All of a sudden, Biden's center tendency, $3.5 trillion down to the midpoint, $1.75 trillion. You ask, what happened?
He has no other choice. How else is he going to get this through? He doesn't have the votes, and this is the bottom line, and he wants to get something done. If he gets nothing done, how does he go into the 2022 elections that are going to be really pivotal for who has the dominance in Washington?
Only on Bloomberg, on radio and television. John Farrow and I can look at magnesium either out of Rotterdam or we can out of China. John, magnesium to the moon, up 200-some% off of the China quote as well. Rotterdam showing much the same thing. And John, this is the underpinning of what commodities signal. I'm not sure what they signal.
Supply issues, Tom. Near-term prices, spot prices in copper, serious supply issues, stockpiles just dwindling. We see that in the crude market as well. What's the concept, Tom? Backwardation. Going to hear a lot about that word for a few more weeks still to come.
Some jawboning coming here. Let's do the data check. John, do you lead with magnesium?
Yes, Tom. I don't. In the bond market, yields unchanged at 163 on 10s. You can tell we don't talk before the show starts. Don't talk after either. Go for breakfast at about 10:05 and just stare each other down for about 45 minutes. What happened? Down 0.1% on the S&P. Just a little bit lighter, softer, lower here, Tom. No drama this morning. For me, it's just a build-up to November 3rd, the next Fed meeting. It's not about tapering, Tom. It's about rate guidance.
And what's so important, John, I'm off my, magnesium pills today. Is the only reason I was here after my
and your zinc pills too, Tom. Zinc's had some trouble too.
I took my magnesium supplements this morning.
Very personal
to get here as well. Okay, so let's do this. Let's dive in now to the equity markets. Dan Ives will join us here on tech. We're going to try to have him give us a $200 top tick on Apple. We're not going to do that with Beata Kerr. She's co-head of investment strategies, Bernstein Private Wealth, but she is in the heart of the earnings season, as are Gina Martin Adams. What is the trajectory of earnings that you see, Ms. Kerr?
Well, what we see is an earnings season that's likely to be more volatile than the last several. We're coming off of a substantial rebound in earnings, whereas in prior quarters, earnings are up 45% year over year. The consensus view for 22 has really moved to a 9% year over year view. Now, that's still positive, and that's one of the fundamental underpinnings that's really driving the equity market forward. But like you just said, this is going to be a story of figuring out supply and demand. The demand still appears to be there. Who's got pricing power is one of the fundamental differentiators in this earnings season.
Beata, are you buying consumer staples considering how much they've sold off and the fact that we have seen them able to pass along that pricing?
Well, what I would say, Lisa, is it's not about a sector, it's not about a style, it's about the stock picking. Stock picking is back. And even though 30% of managers only are beating the S&P year to date, at Bernstein, we've had great success this year with stock selection. So it's not as easy as saying buy this sector. It's about the company. Do they have the ability to pass on price increases? And some companies do, and some companies don't. So you really have to differentiate by the individual company.
So talk to me about the pillars of support into next year for this equity market. If you're constructive next year, what are the things that you see right now that can persist into a new year?
Well, what we see is still strong economic growth. Obviously, economic growth is fading from the incredible rate at which we were growing in this calendar year, but we're still looking for close to 4% GDP growth in the US and over 4% GDP growth globally for 22. So you've got that as an economic backdrop. We don't think the Fed moves rates until 23. The taper argument is out there, kind of well understood by the market. And as you were just discussing, it looks like we're still going to get some stimulus, even though it is a measured pace.
This is really important. You have 4% U.S. vision for how long, Beata?
That's for 2022. And like you said earlier, the visibility is murkier, Tom. So there's a wider range around that.
Yeah, fair. Okay, but how do you get to that optimism? We got most people way under you on that. What's the Bernstein call that gives you that enthusiasm?
Well, I really...
Clearly unhappy with the question there, Tom.
But the view is...
Beata, if you can you restart the response to that? Because we just cut you off at the very beginning. Do you mind?
Oh, yeah, no problem. I would say that the Bernstein bottom-up view to get to that economic perspective is still that there is tremendous support in the overall output. What we're seeing is while you see manufacturing plateauing a bit, you still got services rebounding. Look at the supply and demand issue. The real issue has really been in goods. Services are coming back. You just said it earlier. Consumers are coming back. Families are traveling again. We do have to be careful on the lower end of the consumer, especially, but what we see broadly is still support for that strong economic growth.
Beata, one aspect of debate on this show repeatedly over the past few months has been what the investment thesis is around what's going on in Washington, D.C. We've seen mostly dysfunction, but they are working to get something done. How do you price in the idea of more fiscal stimulus, but also the idea of higher corporate taxes?
Yeah, we think the market's really acknowledging that the corporate tax rate is going to move up a couple of percentage points. So you're looking at a mid-single digit hit to earnings growth. So there is some vulnerability in that current consensus number. The market's been in a wait and see mode to see what actually happens. But if you look over the last 6 months, nothing close to what was originally proposed is going to happen. So while there is some downside pressure from the corporate tax rate likely to come up, it's far less threatening than it was at the outset. And then, like you said, Lisa, there's the offset of more stimulus actually coming in to support the consumer. So I think the market's, sanguine. Again, it comes back to companies, pricing power. That supply-demand picture is going to be much more important for earnings outcomes and ultimately market outcomes.
Beata, we've been talking about some of the pessimism out there and that markets have rallied despite all of that gloomy talk. What is the biggest concern among clients who you speak to who have to figure out how to reposition?
Well, it's not just the biggest concern amongst clients, but it's something that we're watching the most closely as a potential risk for the market. And it's what we've already brought up several times. Is inflation transitory? And our house view is that it is going to moderate from the extraordinary price increases that we've seen over the summer, but that the likelihood of it being higher than it was pre-pandemic is going up. So we're not talking about a 1970s type environment, but we are talking about an environment that's in the 2 to 3% range in all likelihood compared to the much lower numbers that we saw pre-pandemic.
Beata, thank you. And our apologies for that very small, brief technical disruption. Beata Kerr there of Bernstein Private Wealth Management on the path forward. On the Fed speak today, Bostic, Kashkari, Evans, Bullard, Qualls, take your pick, Tom. Everybody speaking this week into Chairman Powell this Friday.
They're all going to be the first paragraph. These are my views and not the views of the Fed as well. And I have mixed feelings here, John. I think it's important for public officials to get out and speak, you know, at Rotary clubs and frankly big events and all that. But at the same time, I'm not sure what, you know, do we overanalyze it? I really don't know.
I do wonder, Tom, I do wonder
do they
how
do
aligned
this in England?
this Fed is. Not as much as they do here in the United States. The regional Fed presidents, Lisa, increasingly very, very busy talking.
Yeah, but when Tom asks, do we overanalyze, people are kind of viewing it as noise. How much analytics are there really at this point from some of those speeches? What are they actually going to say? Increasingly, I hear from investors basically ignore everyone except for the big three at the top. And that, I think, has changed a little bit due to some of the political pressures. But, John, that's my sense.
Well, that's the issue. Who are the big three at the top next year?
That's a good question.
I mean, you can talk about the big three at the top, Tom, for the next several months. I mean, next year, that's an open debate, isn't it?
Yeah, it's an open debate, but with the data, I mean, if you get the Bernstein 4% GDP, John, the vast majority of the people we're talking to aren't modeling that in.
The direction of travel matters on inflation here. If we get inflation trending lower and we get 4% GDP, Tom, that's a hot economy, fertile for risk assets. You say not many people are pricing that in, Tom. That's consensus for next year. When you look at the economic outlook, ECFC go on the Bloomberg, 4 handles consensus. Okay, so most people are looking for that. For me, Tom, it's more back end of next year.
I got to take some Bloomberg terminal lessons.
Yeah, of course. Okay, less of the snark, TK. I love you. I know you know.
I'll go up to
just
the
for other people that might be brand new subscribers that don't know.
Some lessons.
Okay. We'll talk about this in a break. It's okay.
It's okay.
I think the world of you.
You know, John, I'm rattled. I took my magnesium and I just learned I need 420 milligrams a day because it's for older people.
Is that right?
And abuse of alcohol. Is that why they gave it to me yesterday?
Do you want me to say something back to this?
They said cashews. Cashew nuts.
I'll bring some cashews.
Lots
in
of
for
cashews.
You.
I need cashews.
Look at the clock, TK. It's time to go. Tom Keene.
I'm working
Lisa
today.
Bramis
Come on, I had my
Jonathan
booster
Farrow.
shot.
This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Congressional Democrats have made headway in breaking their stalemate on President Biden's economic agenda by getting rid of or trimming parts of the multi-trillion-dollar tax and spending package. Progress came after the president met with various lawmakers yesterday. Expected targets for cuts include tuition-free community college and a shortening of the expanded child tax credit extension. Now, a volcano in southern Japan erupted today, sending a massive column of gray smoke into the sky. The Japan Meteorological Agency raised the warning level for Mount Aso to 3 on a scale of 5, warning hikers and residents to avoid the mountain. The warning was also issued for the city of Aso and 2 nearby towns. Bundesbank President Jens Weidmann is stepping down from his post at the end of the year. A statement from the central bank says he submitted his resignation to the German president for personal reasons. The 53-year-old has been Germany's central bank chief for more than a decade and is considered one of the more hawkish members of the European Central Bank Governing Council. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you look at technology, how should we be looking at big banks and technology?
Technology is our friend. So it's helping us transform the bank fundamentally. And in fact, we're speaking, I think, as we speak, to our shareholders around what we've done and how we've transformed the bank. We also see technology, and technology companies as partners. So some
Not
of our
rivals.
You know, we know that there are big parts of what have been our business historically that will be absorbed into convenience platforms. And by convenience platforms, whether that's Amazon or Facebook or Alibaba or Tencent or something like that, those are platforms that are just very convenient for people to conduct their day-to-day financial affairs. And it'd be very difficult for a bank to compete with that. Now, in some cases, I'd say, let's say in Africa, we are setting up a competing platform to the convenience platforms. And we're working with technology companies and mobile telephony companies and others to create a platform of our own. But for the most part, we're going to be playing on somebody else's platform.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics? Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Any other auto manufacturer who wants the same performance and the same range at the same price will have to lose money on every car sold. 3,000 is our base case, not our bull case, but our base case.
Always fantastic to hear from Kathy Wood there, the CEO and CIO of ARK Investments, sitting down with Carol Massel on the West Coast for the Milken Conference from New York City this morning. Good morning. We can talk about Tesla alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Your equity market's down 2. No drama on the S&P, negative 0.03% into the bond market. Basically unchanged there most of the morning at 116.25 on euro dollar. We're basically unchanged through most of the morning. 162 on 10s. In the commodity market, we've got a move there. We're down 1% on crude to $82.11. But the focus, Tom, now very much on the big tech players. I don't know if we can call Tesla a big tech player.
Yeah.
But we can call Apple one. Apple, month end, Tom, October 28th.
Widely anticipated by Global Wall Street, we bring in Daniel Ives, senior equity research analyst at Wedbush. We'll do Apple here. One question on Tesla this morning, Dan Ives. Reaffirm the accounting integrity that gets you to 1,000 on Tesla and Ms. Wood to 3,000.
Well, I think it continues. I never viewed Tesla as an automotive company. I view it as a disruptive technology player. And it comes down to, can they do 1.3 to 1.4 million units next year for a company that's now starting to be profitable selling cars? You put that together, some of the parts, I think $1,000 is the base case. I think bull case, you get to 1,300.
We've got a reset on Apple. The new toys are, the new chip is extraordinary, up by 12 core speed. For those that don't understand that, all you need to know is they're technological marvels. Do you adjust your bull case, not your call of 185, 190, 200, but to get out to a $3 trillion Apple at $181 a share or a $4 trillion Apple at $241 a share? State the bull case.
Yeah, and bull case now 225 was 200, And I think the part that's really the delta is the innovation from a margin expansion story that you're going to see at Apple on their new chips, as well as what I believe, forget just the chip shortage for a second, but right now demand's outstripping supply by about 10 to 15,000, iPhones, I'd say per day. You sort of put that together. This is something that, I believe right now we're running into about a 5% shortages on iPhone going into holiday season.
Have you got an idea, Dan, of what the product mix is like around that shortage? Is it the high-margin goods that can't get the chips? What is it? Is it broad-based? What's your read on that, Dan? It's important for the margin story.
Yeah, I mean, we could call it about 5 to 10 million shortage that you could see going into holiday when you put it all together. But I think the one thing, too, is ASPs continue to trend much higher. China, the star of the show for Apple, that's going to be front and center going into next week. I think you put this all together. We think this is a $3 trillion market cap going to early next year, as well as the services, continues to be the accelerant in that Cupertino growth story. Now, you got 2 new products from a hardware perspective in terms of Mac Pros, Tom talked about, and AirPods. I continue to think this is just a massive growth renaissance in Cupertino.
Dan, hard to game this out, but just for this quarter, given the supply issues, can you envision a story where we miss on the top line, but beat on the bottom line for everything you've described?
Well, I see it. It's a beat on September across the board. I think mixed guidance for December, maybe cut it by about 2 to 3% just on that unit shortage. But then ultimately 2022 numbers come up. And right now the street's looking through any sort of timing transitory issues on chip shortage to the 2022 growth story. That's why haters will continue to hate on Apple. But in my opinion, this is a stock that continues to move higher. Right now they have a supply issue, not a demand issue, a high-class problem.
Dan, how would you like to see them use their money?
I mean, outside of buying a country, right, which is always an option.
Which
for
one?
them.
No, I'm kidding.
I think they have their choice, but I think right now it's going to continue to be about the buyback dividend. I don't see them. The only acquisitions I see them doing is more and more, we'll call it strategic content acquisitions, as it goes to on Apple TV. But this is all the drum roll to what's going to be the next product innovation coming out of Apple. The AR, VR Apple Glass next year, and then the Apple Car in 2024. I think that's what the drum roll. And Tom talks about how you get to $4 trillion. I think $3 trillion next year, and in the next 2 years, you're looking at a $4 trillion market cap for Apple as this all plays out.
You said that really the accelerant here is the services component. However, Apple's still very much a consumer products company, at least in terms of the reputation of consumers. We see certain pressures with respect to the App Store. What services do you see really driving the charge as we really continue to look for the product side of Apple to innovate?
Yeah, it's a great question. It's all part of the re-rating story. I mean, you go back 18 months ago, services, Street was assigning $300 billion. We think it's worth 1.4 to 1.5 trillion. It's all about monetization on cloud, on App Store, really across the ecosystem. Just go back to some of the headwinds, call it epic trial and regulatory. Street's kind of viewing that as background noise, and that's why this stock is one that continues to power through that for a mid-teen grower in what's a $70 billion annual revenue stream.
Dan, you and I are close. I missed this one. Maybe I missed it a long time ago. When did you start covering GM?
Yeah, so we started covering GM over the last 6 months because my view on GM is that this is going to be an EV transformation story.
Interesting.
As it gets re-rated. And I think what you're seeing at GM and Ford, Renaissance and Detroit, you start to get more of a re-rating. A year from now, GM's a double.
Very quickly, Dan, are they going to make a car America wants? Not some fancy techie thing like Tesla, but something you can get the family in.
I mean, look, 2 weeks ago, I was out at their test driving facility, and I test drove a bunch of the models. I think it's going to be a game changer what they're coming out with at GM. I think Mary and the team, phenomenal job what they're doing on this green tidal wave. They're going to be a big participant. Although right now it's Tesla's world, everyone else is paying rent on EVs.
Well, Dan, just quickly, though, before you run, for people who aren't familiar with the stocks you cover, Apple, Microsoft, DocuSign, are you expecting them to get a tech-like multiple over time?
Well, that's my view. My view is GM and Ford, those start to get re-rated on disruptive technology as they convert that base. You start to do some math, you convert about 10% of GM's base by 2025. I think there's a 3-digit stock. And I think that's the key here as it starts to get more of a re-rating on this green tidal weight. It's a $5 trillion green tidal weight. Tesla's the leader, but many others are going to benefit by what you're seeing. Biggest transformation to the auto industry since 1950s.
Dan, amazing. Fantastic to catch up, sir. Let's spend a bit more time on that in the future. Dan Ives there of Wedbush. On GM, General Motors, the price target over at Wedbush, Tom, 85. Right now, 56.85. And maybe that's the trend still to come, that some of those legacy names over in Detroit, Tom, start to fall under the coverage of the tech analysts like Dan Ives.
You know, I think, John, that we've made no surprise about this, that technology here is grossly underrated. I mean, you know, in fact, Matt Lazzetti could probably talk about this, and that from economics and from buy, hold, sell types, it's real simple. Do we actually understand the technology of the next 10 or 20 years? I don't think so.
I started this segment, Tom, by saying, is Tesla a tech firm? We've had that conversation many times, haven't we? Tech company, automaker.
I'm biased. I can't get in them.
You can't.
No.
Can't get in the Camry either, can you, Tom?
Barely.
That's why you need an
Tom,
Uber, an Uber Black. I've seen you. I've seen how you work in New York.
Okay, thank
I get it. I know. Tom Keene, Lisa Bramage, Jonathan Ferro. Yeah, right. This is Bloomberg.
something wrong with her eye. And when I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm on.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Live from New York City for our audience worldwide, on radio, on TV. This is Bloomberg Surveillance with Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market is unchanged on the S&P, really muted and stable around these levels for the last 2.5 hours. We are going nowhere this morning. Into the bond market, Tom. Yields in about a basis point to 162.67. Euro dollar not doing much either, Tom. 116.32.
Our advantage here, we can rip up the script on breaking news. Is this a big deal? I sort of like, yeah, I think it is.
UniCredit, Tom?
UniCredit, John. Exit London. They're taking the traders to Milan. Discuss.
Well, let's clarify the exit, Tom. And I think you're right to point out it's the traders, and it's most London traders to Milan. The headline reading as follows: UniCredit planning to relocate most London traders to Milan. I don't have any details outside of that headline, Tom.
They'll sell tickets for AC Milan. That's the detail,
Well, let's hope they're AC Milan supporters, Tom.
Yeah.
I'll have a chat to them. I'll reach out to them in London and maybe convert them.
There we go. Right now, we're going to set up Matthew Lazzetti. Deutsche Bank has really been outstanding here. Yes, I've started the rumor. Focus Landau to run the Bundesbank. Good luck with that. But it's always important to talk about the changes in the dynamics of Fed policy around economic growth. And John, you've got a choice comment from Mr. Lazzetti.
Yeah, Tom, there was some buzz around this quote from the other week. With the committee proving to be sensitive to higher than expected inflation data earlier this year, we now expect a greater persistence in these inflation dynamics to lead to liftoff in December 22. Some of the work there from Matt Lazzetti and the team over at Deutsche Bank. So Matt, walk me through it. What's changed for you that says, you know what, they're going in 22?
Sure, thanks so much for having me. And it was a big change from our perspective. Prior, we had expected they wouldn't raise rates until the middle of 2023, essentially. And it's all about inflation from my perspective. What we've seen in the latest data, used car prices, Manheim, were up 5.4% in September, another 8.3% in the first half of October. We've seen oil prices, energy prices moving higher, and I think that's really important for inflation expectations. We know longer. I think on top of that, we have more persistent items. So you have wage growth has picked up on the Atlanta Fed's measure. Rental price inflation was the highest since 2001 in the latest data. And so I think we've just come to the realization that inflation is going to persist for longer. Inflation expectations are likely to rise more than expected. And that's going to bring forward Fed liftoff into next year.
So Matt, I want to be really clear about this. You're questioning the forecast. Are you questioning the reaction function as well? That's a higher bar. That's a higher test. Are you questioning the forecast or the reaction function? Excuse me.
Sure. Sure. So I think it's a little bit of both. I think, the Fed had 2.3% core PC for the end of next year. That's too low from our perspective. We expect it to be a bit higher than that. And then I think if you just look at the evolution of Fed thinking over the past, 6 months or so, we've had this kind of steady, very gradual hawkish movement starting in the June FOMC, two key speeches from Vice Chair Clarida, the September meeting, which ended tapering earlier than we expected in the middle of next year. And pushed it to 50-50 in terms of a rate hike from next year. I think if you continue to get upside surprises on the inflation data in the coming months, the December SEP, the dot plot shows a full rate hike for next year.
What will the growth be? What will the growth be of the American economy?
We're still, pretty bullish on growth. I know that there's certainly all this discussion about stagflation, the supply side shocks that are hitting the economy, lifting inflation and hurting growth. I mean, no doubt that's true for Q3. For Q3, we're down close to the 2% growth in Q3, and very clearly that was a supply shock-driven dent in the economy that was unanticipated, I think. But we've pushed some of that growth out into next year. We've lifted growth for next year to about 3.6%. I think that should be sufficient to get the unemployment rate continuing to fall, closer down to 4% by the end of next year. And so, yes, there are downside risks to growth. Yes, we have to get past through some of these supply chain disruptions and certainly some COVID disruptions and fears. But we remain pretty bullish on the U.S. outlook.
How do you link that in then to markets? When you talk to the strategists, when you give advice to Deutsche Bank strategists, what do you tell them about that linking into nominal GDP into the revenue components?
Yeah, I think the most interesting dynamic that we've seen from a market perspective has been bringing forward Fed liftoff. And so just over the past week, we had seen that almost move forward into June, 50-50 odds of rate hike in June. But at the same time, not really lifting longer term Fed rate hike expectations. So we look at 5-year, 1-year OIS as a measure of the terminal rate. And it's only around 1.75% at this point. So it's pretty bearish in terms of how far the Fed will be able to get. And I think that's all about the growth outlook, expectations that growth will not be as strong as expected. We expect that growth will be there, that rate hikes will not be able to dent that sufficiently, and therefore that the Fed will raise rates more than I think what the market has priced in, particularly as you get out into 2024, where there's this big divergence between our view, the Fed's view on the Fed funds rate, and the market pricing.
Matt, underpinning this is sort of a conundrum that's been facing central bankers and economists alike, which is how do you parse out supply side versus demand side dynamics when it comes to inflation?
So it's really hard. My colleague Justin Widener did a great piece on this recently, replicating some of the San Francisco Fed work around the COVID crisis and really trying to identify supply versus demand factors. And what you came to was supply side factors are critical for a number of items that you would expect, consumer durables, autos in particular. Demand side forces are really important for the items that you would expect as well, lodging away, hotels, restaurants, etc. And I think what we've seen there is from weakness from a consumer spending perspective recently has been mostly supply driven. On the inflation side, what you saw was it was all about supply earlier this year in the late spring and during the summer. And then you started to see those forces dissipate. But I think a really important trend is a pickup in those supply side forces on the inflation front. And I think we're going to see that again over the next several months. And so that is the sense in which these inflation pressures and the supply side story is just persisting a lot longer than anticipated.
The reason why this matters is that if the Fed raises rates into a supply side shock, this doesn't necessarily make as much sense. However, when you take a look at the demand side and you take a look at pricing with respect to particularly rent, which you mentioned, the Fed might have more of an impact. Could raising rates actually be helpful in dampening inflation simply on the read-through to rents and housing prices?
Sure, and you're exactly right. It's the typical conundrum from a monetary policy perspective. It is a supply side shock that the Fed can't do much about. They can't help the chip shortage. They can't help congested ports, certainly on the West Coast. But I think we should know that there is a demand side story here. Retail sales has upshifted over the past year to a much higher level. So demand is pretty robust and it's meeting constrained supply. So there is no doubt a demand side part to this. I think importantly from the Fed side, what they can do is maintain credibility for defending their 2% target, maintain credibility for not wanting to get inflation expectations running too hot or too high away from their target. And so from their perspective, yes, they can help to rein in some demand by raising rates. And so I think that's an important part of it. But I think a really important part of it as well is defending your 2% target as inflation has run hot and trying to bring back inflation expectations and make sure that they're anchored around 2%.
Matt, how difficult is it to have a forecast on what the Fed will do with no idea what the Federal Reserve looks like next year?
Incredibly difficult.
That's a job description.
You have, a really uncertain inflation outlook, a really uncertain labor market and growth outlook. You have these supply side shocks hitting the economy that we haven't seen in decades. And then on top of that, you just don't know what the committee is going to look like over the next year. What I think we do know is the composition of the committee will likely look more dovish. We will probably get a more dovish board member. Perhaps President Rosengren's seat will be replaced with somebody a little bit more dovish. But I think importantly, the voting members next year look a lot more hawkish. And so from a regional Fed president voting bloc, it's a lot more hawkish. We have all of them with a rate hike in 2022. And so that's a big block of voters that expects to raise rates next year, that even if you get a more dovish chair, for example, if Governor Brainerd is the chair, I think it's going to be difficult to push back on that as long as inflation is above the Fed's current forecast.
So to John's good question, fold the China dynamic into it. Off the NX on your calculations 6, 8, 12 months forward. It's undoable, isn't it?
Sure. China growth, the impulse from that has been a really important driver of global growth dynamics over the past decade. And, that is likely to be softening going forward. I think offsetting that is that this story at the moment is primarily about services in the U.S., and that is a domestic-oriented story. And it's also about rebuilding inventories and production. There is demand there. There's sufficient demand there, at least over the next year. And so a lot of it is clearing up these supply chains and getting services spending back in the U.S. economy. So it's more domestically oriented relative to what we're used to.
Matt, fantastic as always. Matt Lazzetti over at Deutsche Bank on the path forward. Deutsche Bank looking for a rate hike in December 22. In many ways, everyone in this business acknowledges this is a guessing game, Tom, but it's about the process. It's about understanding the process that teams like Matt Lazzetti's team goes through to come up with that call. There's a lot of homework that goes into it, and then once you've got that transparency, that clarity, you can make your own decision, Tom, on what you think is going to happen.
It signals, John, why we have these narratives of fear, because, and I don't mean this in terms of gloom, but the uncertainty out there is extraordinary. These conversations this morning, John, have been superb. I mean, I know you have to leave us to go off to another property.
I do, Tom, yeah.
You know, the conversations have been really superb.
I'll be catching up with Priya Misra of TD at the top of the hour. 20 minutes' time. That's the tease, Tom. I was reading Tom Porcelli last night. Some work from Tom Porcelli over at RBC, just on inflation expectations. And Tom has a knack of just making things really, really simple, clear, and to the point, sharp. Here's the quote on inflation expectations. Inflation expectations are incredibly elevated, and that is a factor eroding consumers' desire to spend in earnest, Lisa. He goes on to say, and that is why inflation expectations matter. They matter for some people.
They matter, and it's not clear whether it means that inflation will run hotter or, frankly, whether that will be a natural dampening of that inflation because people are going to perhaps adjust how they behave. This has been a huge debate. I do wonder, though, the idea here of demand side versus supply side inflation and people trying to parse that out as people are dealing with a fiscal runoff, a fiscal cliff.
Lisa, can you bring a more interesting trading session to work with you tomorrow?
Yeah, bring us an auction.
Something, you know, can we have an auction?
Can we have an auction?
I'll bring you a waffle with some Nutella. Actually, today there's a 20-year bond auction today.
There we go, Tom.
Yeah, 1 p.m.
Oh, great. Lisa, bring the offspring in and they can do a Kierkegaard behind you.
Great. Yeah, never.
Equities unchanged, just short of all-time highs. I'm going to run. Tom Keene, Lisa Braverton, Jonathan Ferro. This
John, you
is
said
Bloomberg.
you wanted to run at 600.
That's right, Tom.
With the First Word News, I'm Leanne Gerrans. Former Goldman Sachs chairman and CEO Lloyd Blankfein weighing in on succession at the Federal Reserve.
Who offered that job would decline that? I mean, that's you know, you'd have to be preparing for your end of life or jumping off a cliff or something like that. Of course, that would be you know, to make that kind of a contribution or to be at that fulcrum of that very large lever. Of course, you'd want to do it.
A bipartisan push to make the U.S. more competitive with China and bolster domestic chip production risks falling by the wayside as Congress faces its packed agenda. The Senate passed legislation including funding to strengthen the U.S. semiconductor industry, marked rare cooperation between progressives and Democrats. But Democratic infighting and the GOP feud threatens the bill and could worsen the chip shortage. Facebook is planning to rebrand with a new name that focuses on the metaverse. According to The Verge, the original Facebook apps brand may remain unchanged and could be positioned under a parent company with Instagram and WhatsApp in its portfolio, similar to Google's structure with Alphabet. CEO Mark Zuckerberg is expected to discuss the change at a company conference next week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
China is a gigantic part of our economic
life and will be for a long time, for our lifetimes. That does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. Do
you think you're the last Sinophile in the cabinet?
No, I expect there are lots of... look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Do you consider yourself a filmmaker, a historian, an educator?
Well, you know, the biggest thing is that I'm a filmmaker, and that means I tell stories, and the way a painter might choose to work in oil as opposed to watercolors, I choose to work in history.
So the 1972 Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment, so we do our best to try to give it to them.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Surveillance. Good morning, everyone. Lisa Bramwitz and Tom Keene, John Farrell getting ready to drive the market forward here on TV here in a bit. At Milken, Kathy Wood, the Chief Executive Officer, Chief Investment Officer of ARK Investment, here with Carol Masser. Let's listen.
There are the haves and the have-nots in China, like there is around the world. I think China's taking it more seriously because there's probably more social unrest than we now appreciate. What I don't understand is they're going after real estate, which is 75% of the consumer savings in China.
Individuals in China.
And if yes, individual saving. If the prices are going down, which they have been, I think that could really hurt consumer confidence. I think it already is. And then last weekend, or the weekend before, the government, the national government, went after the regulators who had focused on the financial industry, as well as the financial institutions. And I'm just saying, wow, they're playing with fire.
It's a movie, yeah.
And talk about a cyclical risk out there. Think about that if we lose China. At the margin, China has been responsible for a tremendous amount of cyclical growth.
Tell me a little bit more about Bitcoin and where you see, I mean, I've never seen anything so debated. Obviously, we're seeing more legitimization as we see regulators, certainly in the US and around the world, moving forward. Today was a big day. What is the long-term play when it comes to something like cryptocurrencies and Bitcoin?
So Bitcoin specifically, we got involved when it was a $6 billion market cap, and here's Art Laffer again in my life and in ARK's life. It was a $6 billion cap then. Now it's over $1 trillion, which is, but We were asking the question, this was 2015, could Bitcoin serve the three roles of money? And we came to the conclusion that it was possible. Art Laffer collaborated. He tore our original paper up. And as we were going through it, he said, this is the rules-based monetary system I've been waiting for since we left the gold exchange standard, 1971.
Right.
And I said to him, oh, how big could this be? And he said, well, how big is the US monetary base? And back then, remember, this is a $6 billion cap. Back then, it was a $4.5 trillion monetary base. Today, we're at $8.5 trillion.
Kirsten Wood there of ARK Investment with our Carol Masser in a You Could Hear a Pin Drop Room, the Milken Conference out in Los Angeles. We need to talk about Los Angeles County. Lisa's going to kick that off with a must-read essay of detail, optimism on the strength of Southern California. Matthew Winkler has provided real leadership on a California that's going to fall off into the Pacific Ocean. We'll get into that in a minute. It's time for a Winkler Victory Lap. Editor-in-Chief Emeritus joins us this morning. December of 2018, you did not say buy, hold, sell, but you said, here are the observable facts on Tesla. It's up 144% per year since you sat on our set. What does the view forward for Tesla look like to you and Shinpei and your research team?
Always great to be with you, Tom. Thank you for that. And I would say the person who has been most prescient is actually Cathie Wood. And she, of course, has opined this week about Tesla.
She's a pinata. Everybody hates her. Why?
Well, she's very data-driven. And one of the things that she keeps coming back to is just how much knowledge Tesla has about the people who own its cars and drive its cars. And that's a huge advantage compared to all of the competitors. And you can see that in the sales of Tesla vehicles, you know, at a time when you would have thought, particularly in the US, that Tesla would be under pressure. It's actually the exact opposite. The outlook, as far as she's concerned, is probably as bright as it's ever been.
One thing that you do so well, Matt, is you challenge conventional wisdom, and this comes at a time when Tesla actually just moved its headquarters to Austin, Texas. This sort of feeds into the narrative that Southern California is losing everyone. People are fleeing, and it is an economic wasteland.
Fall into the Pacific Ocean.
Exactly. What you just wrote that out on the Bloomberg terminal absolutely contradicts that. Can you explain why you see such optimism in that region?
Well, what people forget is that California, being the most diverse state and the largest state, happens to have the most diverse economy as well, and in fact is the fifth largest economy, if it were a country, in the world. One of the strengths of California is that it is the supreme gateway to U.S. trade. By that I mean, if you took the Long Beach and L.A. ports together, they are overwhelmingly responsible for just about everything that we take in from anywhere in the world, particularly in Asia, where we get most of our stuff. And that, in turn, has created an enormous manufacturing base in California. People forget that L.A. is the largest manufacturing center in the United States among all of our cities. And that has been a consequence in part because so much of the infrastructure that is required to process goods and services that come from elsewhere go through LA.
And I stood there, I was out there with a family here a while back and just stunned at the visible, tangible, embedded diversity. Forget about the modern wokeness of diversity. They're doing diversity a decade, it would seem to me, or more ahead of America.
Yeah, and something that Mayor Eric Garcetti has pointed out is that if you look at the Los Angeles airport, for example, which is one of the few that has, or at least before COVID, daily nonstops to 6 continents. You know, just one big airliner coming in twice a day from outside the United States is worth, a Fortune 500 company. And people forget that. And so that speaks to part of the diversity, but it also speaks to the fact that LA is a lot of very small companies that are doing very well.
We're out of time. Dodgers over Braves. You want to continue with the LA tone?
I always love the Dodgers.
Okay, there we go. Matthew Winkler, baseball expert, joining us today, our former editor-in-chief, founder of Bloomberg News, I should say. A really important essay. I'll get it on Twitter here in a bit. Lisa, it really speaks to the vibrancy of the entire region.
And frankly, the winners and the losers from some of the supply chain disruptions, highlighting how Los Angeles very much is a beneficiary of being such a node of economic importance in the United States, being such a major port. I will just say, talking about the winners and losers of supply chain disruptions, talking about the fact that Nestle can really pass along a lot of those price increases. Procter & Gamble, the same. The question of how much margins can squeeze and what's been priced in, given how much some of these companies, consumer product companies, have lagged behind. To me, this is the most fascinating aspect of earnings going forward.
I would say it's the most not uncertain but convoluted earnings season I've ever seen. The idea here of what are we going to observe? I believe there was someone that told me a number of years ago, Lisa, show don't tell. So we will try to show earnings and show the makeup of revenue here. And if I don't, I'll probably be in trouble.
If we don't
show it
right now, there's not a lot to show for it in markets. They are pretty range bound. And I will say, Pharaoh's asked me to bring a more interesting trading session to the market tomorrow. Do my best.
Maybe we'll show down the income statement as well so I can keep
my copper stores.
Stay with us on radio and TV. We're going to show, not tell. This is Bloomberg.
OECD nations need to end coal use by 2030, developing nations need to follow suit by 2040, and we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
It's such an interesting new world.
The world is changing. For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
There's always a balance between the free speech and being responsible and taking down content that we think could lead to some kind of real-world harm.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. This price action is a total snooze from New York City for our audience worldwide. Good morning, good morning. Equity futures doing absolutely nothing, unchanged. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
From New York, we begin with the big issue within striking distance of all-time highs.
Earnings growth has just been off the charts.
Markets are feeling, reasonably emboldened.
Yes, there are reasonable concerns about margins. A lot of talk at the moment around inflation. Given the supply chain issues,
margins are still pretty resilient.
We've not really seen a huge impact from the supply chain disruptions.
The inflation concerns right now are really from the supply side.
It's really yet to squeeze margins. The earnings story has overpowered that.
Earnings have been stellar.
We have strong earnings.
Earnings was going to be a catalyst to get the markets to recover.
That's been powering the market higher.
Frankly, we still think that has legs.
There's a lot of cash on the sidelines supporting this market.
There's something for everybody.
There is something for everybody. Joining us now is TD's Priya Misra, Bank of America's Jared Woodard, and JP Morgan's Phil Guarco. Guys, we seem to be completely divorced from the conversations we're having right now every single day. For all the doom and the gloom, the equity market, Priya, is within striking distance of all-time highs. For all the talk of stagflation, 10 to still only at 160. What do you make of that, Priya? The everyday conversation and, quite simply, the price on the screen.
Right. So I do think that there's a little bit of a disconnect here. I think the rates market is pricing in structural, I don't know whether I call it stagflation or a policy mistake, or that the Fed is going to start hiking next year, but then can only hike up to 1.5. And I think the equity market takes that to mean low negative real rates, or 10-year real rates at -1% is extremely positive for equities. But if the bond market is right, that the Fed cannot hike more than 1.5%, well, then I think that actually is a very negative outlook for long-term growth. So I think there is a bit of a disconnect here. We're actually arguing that the bond market might be a little too trigger happy for the Fed, thinking that the Fed will start hiking that soon. If they start later, I think the Fed will actually raise rates much more. So, I think the bond market here is so nervous about inflation and is almost saying that the Fed will be forced in. I think they're all calling, all bond markets in the front end are calling central banks bluff. So now I think the ball is back in the central bank's court. They have to push back. And I think until we hear that, you might see this disconnect persist.
Well, if you're going to hear it, you might hear it Friday. Chairman Powell on deck this coming Friday. Jared, I wanted your view on this disconnect as well. Your view on it.
Well, look, I think there's an essential question that perhaps the Fed wants to see answered first before they communicate a new information, which is, will the market mechanism work? Is this a situation in which there's excess demand? Yes. There's a shortage of goods? Yes. Can higher prices temper some of that demand, the demand that's causing the shortages? And if it can, then you end up with maybe not stellar growth next year, maybe not 5% GDP growth next year, but 4% or 3%, levels which we still, a decade ago, would have been incredibly enthusiastic about. And if the market mechanism can work, if higher prices can temper some of that excess demand a little bit, that reduces the need for Fed intervention. I mean, think about it. Why would the Fed intervene to raise interest rates and curb demand if the market can do that anyway?
Price can settle this story. Higher prices can settle higher prices. What's remarkable about this for so many people? Equity markets near all-time highs in the face of a conversation about slowing Chinese growth, higher interest rates. China just had a drop in home prices for the first time in 6 years. Some people are taking notice. Bank of America's Savita Subramaniam is one of them, talking about the broader impact of a China slowdown and what it means for EPS on the S&P. Our economists cut their China GDP forecast by 1.3% in 22. That translates to a 4.4% hit to EPS on the S&P 500. There was a cut to 1.3% to 22, a near-term cut for 21 as well. And Phil, I want your view on this, what the slowdown in China ultimately means for the S&P 500, for earnings in America.
Yeah, thanks, Jonathan. I think that's going to be delayed. I think that the big thing in terms of where we've gone on market highs over the last week really was the financial sector earnings that started last week. I think the banks were basically saying that the recovery we've had so far has been prepaid. You see it with all the high balances that people and businesses have on, and that's going to continue because those balances are still there, even though they're coming down a little bit, but credit availability is still there because we really haven't been lending. And, you know, speaking for JP Morgan, we just love to lend and we want to do more. I think the China thing is going to hurt us going forward, and it's a timing issue. And I think really the issue is how bad is this kind of almost Minsky-like debt destruction episode that they're going to have there going to affect them. I think some of the places where you see it in terms of our view is in copper. One would think that copper, we should be projecting copper prices to continue going higher because of the recovery and also because of, say, EVs. But, you know, we're getting a little bit cautious about that, and that's really because of China. And that's because, you know, how many houses are they going to be building in China over the next 2 years? And that may cause some export of deflation from China, certainly in building products, but we'll have to wait and see for other things. So it's coming. I just wonder how long it's going to take before it hits us. But in the meantime, I think our profits are going to continue to be quite robust.
There's so many issues to resolve, and corporate America so far has been really, really resilient. We heard from the United CEO, Scott Kirby, recently. He said the following: from the return of business travel and the planned reopening of Europe and early indications for opening of the Pacific, the headwinds we faced are turning into tailwinds. The commentary so far in earnings season hasn't been all that bad. With more, here's Kaylee Lyons. Hey, Kaylee.
It hasn't been bad at all, John. In fact, United posting a narrower loss than expected in its earnings yesterday, and better than expected really seems to be the name of the game of earnings season thus far. Of course, it kicked off in full swing 1 week ago with JP Morgan, and in the 5 trading days since, the S&P 500 has risen in every single one, the longest winning streak since August. And my producer Pete tells me that is the best start to an earnings season of the pandemic era, with a gain of about 3.5% over the last 5 days. We are now just within 1% of an all-time high. So clearly the market has liked what it's seen thus far. Remember, we came into earnings season with a lot of fears out there about the margin story, given some of the supply chain pressures, logistics headaches that are causing delays and really potentially crimping corporate margins given the higher input costs. But by and large, that hasn't actually happened. Average earnings growth in the third quarter thus far, near 36%, and the average beat to the upside is 13%, which shows really companies have by and large been able to pass on those higher input costs to their customers. That's easier for some sectors to do, though, than others, John. One of those groups hit harder is consumer staples, and we saw that evidenced by Procter & Gamble yesterday with its gross margin squeezed, warning of higher costs due to commodity and freight prices. And P&G, of course, is the heaviest weighting in the staples sector, which is the second worst performing industry group in the S&P 500 this year and is now at its lowest relative to the broader index in 20 years, John.
Kaylee, thank you. So much of this conversation already naturally gravitating towards a conversation about the Federal Reserve. You heard that from Priya and from Jared. We caught up with Emily Rowland of John Hancock recently about this. Take a listen.
Monetary policy is not equipped to deal with these supply side problems. Monetary policy is not going to help bring these ships back into port. The Fed right now is really stuck between a rock and a hard place.
Priya Misra, do you agree?
I agree. I also think that communication is a particularly tough challenge here, too, because inflation's high. The Fed has signaled imminent tapering. They've also even signaled a faster pace of tapering. So for them to come out right now and say inflation could hurt the economy and therefore we don't need to hike, well, then that flies in the face of then why are we tapering? So I think the Fed, not only do they have a tough spot, because I would argue this is not demand-led inflation, this is supply-led, and which they really can't control. They're also trying to exit. So while exiting, they have to talk about a positive outlook and, you know, how the economy can handle the exit. But I think they have to caution on the hike front. I think the market's gone beyond tapering. We've priced it in. Now it's all about hikes, and the market's moved the hikes now to the third quarter of next year, which I think is way too soon, but very hard for the Fed to push back if they're tapering.
So, Priya, my question to you, what do you think people are getting wrong here? From your perspective, your opinion, this is your opinion. Do you think people have got their forecast for inflation wrong next year? Are they questioning the Fed's reaction function? Which one is it?
I think it's both. So part of it is inflation. I think there's a lot of questions about how much is the supply chain. I mean, we have seen rents going up. Normally, rental inflation tends to be trending. I would argue you had such a big shift out of cities and now people are coming back. I would argue there is a temporary nature to rents, but we really don't know. Historically, rents tends to be trending. So I think people have fundamentally reassessed the inflation outlook. The length of time that it's transitory, we call it transitory for longer, which seems like an oxymoron. But I think not only is a higher trajectory of inflation, longer duration, and the Fed reaction function, because I think what we're hearing from the Bank of England, or I think the market's questioning the RBA, I think globally central banks are reassessing how comfortable are they with an overshoot and for how long. So I think people are reassessing both, which is why those hikes and central banks are exiting. So, if they've taken the first step, well, then the second step need not be so far away. So you're right. I would argue it's both the outlook as well as the reaction function. And the Fed really can't do much to clarify the outlook or the reaction function, frankly, right now.
Priya, you and I both agree on this. So to be clear, it doesn't seem like an oxymoron. It is an oxymoron to be transitory for longer and keep saying transitory for longer. Jared, I know that you disagree on the stagflation hype, and no one, as far as I can hear, is doing that this morning. The energy story seems to have seems to be bleeding into a lot of these conversations. Jared, I think some historical analysis is important here. The importance of energy and how it spills over into wage negotiations, how much smaller the unions are as a factor in the labour market. How important is all of that, Jared?
Well, I think it is very important because the concern about stagflation, about analogies from the 1960s and 1970s are kind of everywhere you turn. But when we wrote about this recently, we thought, what are the analogies and what are the disanalogies? There's a lot of differences that are really meaningful. It's not just labor. I mean, that's an important one. When that warehouse in Alabama for Amazon tried to unionize recently this year, I think it was voted down on a 2-to-1 margin. The union membership in the United States is the lowest at the end of 2020 on record. And it's really hard to imagine that somehow 6 or 12 months of unusual, very unusual circumstances could have somehow reversed 30 or 40 years of a decline in labor, bargaining power. But it's not just labor and unions, it's also the effects of globalization. If you look at the elasticity, the relationship between wage costs and core PCE inflation, over the last several decades, you can see a steady decline, whether it's NAFTA in 1994, China entering the WTO in 2001. I mean, these were massive shocks that flooded the global labor market and meant that now employers, they know very well, if there is any genuine increase in wage costs, they can offshore, they can introduce new technology and automation. In fact, that's what we're seeing many companies in many different sectors start to do. That's why one of our theses has been that investors should buy, small T tech, not just capital T tech. Buy companies and businesses, not just necessarily in the tech sector, that can take advantage of new technology, boost productivity, if wages do start to rise sustainably.
Phil Guarco, just quickly to you. Are you willing to fade this inflation concern as well? And what does fading it look like?
Yeah, I am willing to fade it. I think the way fading it looks like, Jonathan, is really to have a target in mind on when you start adding to duration in portfolios. Last time I was on the show, I think I said 192%. I'm going to stick with that. I think, as Priya was mentioning before, there is a limit to how high rates and inflation can get up. The word transitory means not permanent. I think that may still be excellent. It's just we all assume the word transitory was much shorter than the real definition of the meaning is. If I do have one concern, though, it is going to be what the excess liquidity in terms of kicking up housing prices is done, in terms of how that's going to have knock-on effects on rent. So that's one I'm going to be watching going forward. What's the hit going to be the rents? And I think that's driven by the liquidity that drove up prices.
I was putting a 12-month expiration on the term. We're not there yet, though. Jared, thank you. Jared, sticking with us alongside Priya Misra, Phil Guarco. Phil, Jared, Priya, sticking with us. Coming up on the program, some progress on the Biden agenda.
Build Back Better legislation is going to dramatically improve the lives of tens of millions of American families for years to come. We still have work to do, but we're going to continue at it until the job is done.
The latest down in D.C. is up next. This is Bloomberg.
inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Get it done this week. We have to come to an agreement. Everyone is going to be disappointed in certain things, but everyone's going to be glad about certain things.
Democrats moving closer to breaking a stalemate on President Biden's agenda by scaling back spending measures. The press secretary, Jen Psaki, writing in a statement the following: there was a broad agreement that there's urgency in moving forward over the next several days and that the window for finalizing a package is closing. Joining us now in D.C. is our Washington correspondent, Bloomberg's Anne-Marie Bourdin. Morning, Anne-Marie.
Good morning, John. We're moving ever so closely to at least getting what Senator Joe Manchin called a meeting of the minds. And this is what the president did all day yesterday. He met with the progressive side of the party as well as the more moderate centrist wing of his party. And he's trying to get to the middle of what the entire spectrum of his party, because they only have very slim majorities, can all agree on to push this package through. And this is really at the heart of what the president is trying to do, Jonathan. He's trying to make sure that the package is tolerable to the likes of Senator Joe Manchin and Kyrsten Sinema from Arizona, but also not lose those critical votes. Senator Bernie Sanders, who's very much so in favor of a very broad and robust Medicare package, or even Senator Murphy, who wants to see those climate initiatives. What we do know is that that community college provision, that is going to get parked at the moment. That's not going to make it into the bill. Medicare is there, potentially still negotiations about the talks of slimming that down slightly. And then you have things like the child tax credit. That will be extended, though, only for a year. At one point, it was going to 2025. So you could see where they're trying to get as many principles as they can, but at the same time work this down. Because right now, Jonathan, the bill could be cut potentially in half to as low as $1.75 trillion from what the initial package of $3.5 trillion.
Just quickly, AMH, have we made some progress in Washington for once? Just a baby step.
It's a baby step. I agree with you. There's a little bit of progress. I wouldn't get too excited. There is a number of issues they need to figure out. If they're not going to have the clean electricity program, how are they going to fill that hole to make sure they're halving emissions by the end of the decade? Also key to get something together before the president goes to Scotland and meets with world leaders. The IRS, the SALT tax deductions, all of these still need to be addressed.
Anne-Marie, thank you. MH down in D.C. on the path forward. The path forward is really difficult. We talk about this so often. The range of outcomes is incredibly wide for fiscal policy. What have people been doing more recently? Well, in the fund manager survey at Bank of America, they've been going to cash. They've been going to cash. This is what David Jones had to say. Take a listen.
One of the big takeaways for me from the survey is the capitulation in bond holdings. The net overweight at an all-time, net underweight at an all-time high. And that is what saw investors go into cash. They were taking money out of bonds and into cash.
Priya Misra back with us, Jared Woodard, Phil Guarco. Jared, you're not as close to the fund manager survey as you used to be, though I imagine you still read it. Can you walk me through this record low allocation to bonds here, Jared? Do bonds do what they used to do?
I don't think they work quite as well, especially when you think about treasury bonds. The thesis about the end of 60-40, for us is simply that that reliable, portfolio hedge that you had from treasuries over the past several decades, not just the negative correlation to equities, but also the reasonable, stream of income, those things aren't as true anymore. And I think a lot of investors are alert to this fact now, and they've been trimming those holdings, especially longer duration assets in treasuries, in investment grade bonds. And they're less willing to kind of wait for a very tiny coupon that may or may not offset their losses in an equity correction. And they're really shifted otherwise. When treasuries are at 1.6, that's arguably not really worth holding if you're a conventional asset allocator.
Phil, when this conversation comes up with you and the team, how do you navigate it?
Well, I think there's one thing about asset allocators that's, maybe to disagree slightly with Jared, is that from an absolute return or total return basis, yes, you want to be short, and yes, we have been short. But if you're a fund manager having a multi-asset portfolio, if you close that gap on duration or bonds that you've had, basically you're monetizing your gains for the year, and you just book that. So I think there's two things out there. There's that kind of absolute total return sense, but I think there's still a lot of multi-asset fund managers who are waiting to get in and just basically fix their year and in a way, fix their bonuses.
Priya, I've heard a ton of people call the end of the bond market, the death of the bond market, so many times over the last several years. Has the role of fixed income securities, Treasury specifically, changed in the last year?
So, I think of fixed income as there's a duration component, absolutely. And I think, with the 10-year at 160, duration may not look that attractive. If real rates start to turn closer to positive, 10-year real rates closer to zero, I think then there is a value in duration. But I think government bonds also give you liquidity. We're in an environment where if the markets shut down, March 2020 was one example. We've had other examples where liquidity becomes impaired. Having treasuries in your portfolio, and I would say right now, the 0 to 5 year look very attractive. The market's pricing in hikes next year. If the economy slows down, risk assets are going to struggle, and that 5 year is going to really outperform. So, rather than giving up bonds as a whole, I would say being careful on where you are on the curve, making sure you've got liquid government bonds for your sort of liquidity hedge as you're reaching out the credit spectrum or reaching out the risk spectrum. I think there's a value. I just think we have to be more careful, sort of dig into more of the details of where you are in bonds. But I absolutely think that there's value, diversified portfolio, especially with equities near their highs. I think bonds have a role. I may be a bit axed given that I'm in the bond market, but I think there's a role to play here.
Priya, I love catching up with you. The Queen of Rates term, that name is catching on, Priya. It's fantastic. Priya Misra, love hearing from you, alongside Jared Woodard and Phil Guarco. Jared and Phil are going to stick with us through the opening bell on the equity side of things. Developing story, it's Evergrande. It has been for the last several months now. Here's a little bit more news for you with Abby.
Hey, John, there is certainly lots of news on Evergrande, lots of headlines crossing the Bloomberg terminal over the last few minutes. The key headline appears to be that China Evergrande has filed an application to resume trading for its stock on October 21st, so tomorrow, essentially. It was suspended September 30th on the possibility of default. Now, what makes this so interesting is it may suggest that they are going to make that $83.5 million bond payment that was due in September. They were extended the 30-day grace period. They have until Saturday. There's also other debt, as you know, nearly $200 million due, but it may suggest, again, that they are going to, in fact, be able to make that payment. We don't know if they're asking to trade. The other two headlines to pass are the fact that Hoop Life, they have terminated their deal with Hobson over the unit stake sale, and they also, with that, the Hoop Life deal for property management seems to be done right now. And they're also saying right now we'll continue measures to ease liquidity issues. But that application for its stock to trade again would seem to be, maybe, John, some good news here.
I've got no idea on this one, Abby, but we'll leave that one there. Abby, thank you. Coming up in the morning calls and later, big tech moving into the spotlight. Netflix reporting after the close. From New York, this is Bloomberg. 5-day rally turning into a snooze. This equity market totally unchanged. That's the price action. Here are your morning calls. We begin first up with Mizuho downgrading Micron to neutral, seeing limited upside due to a near-term pricing and demand headwinds. Your second call from Credit Suisse, upgrading Ford to outperform, touting the automaker's significant turnaround and rapid transition to electric vehicles. And finally, Deutsche Bank downgrading Netflix to a hold after they kicked off earnings season for big tech after the close yesterday, citing valuation concerns on the stock. We're down by a little more than 2% on Netflix. Up next, we'll talk a little bit more about those earnings and break down the results and look ahead to next week's numbers.
Jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones really for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A 5-day winning streak into Wednesday. Can we add some weight to it? Here's your equity market going into the cash open this Wednesday morning. We're positive about 4 points, up almost 1/10%. It has been a snooze through most of the week so far. We just keep adding to those gains and inching back to all-time highs. Not a snooze in the bond market. Switch up the board and get to the bond market. 2-year yields have been repricing over the last couple of weeks. Then we started to fade the move. 10s again. They look like this, 164.26. Yields higher by about a basis point. Euro dollar 116.39 unchanged there. Crude negative about 1%, 82.12. The opening bow, we advanced 0.05%. A small day of gains potentially on the cards for a 6th day of gains on the S&P 500. Healthcare top of the pile, up 0.6%. Energy bottom of the pile, down 0.5%, with crude down about 1%. That's the price action in the early part of the session. Netflix, after the close yesterday, reporting some big subscriber growth. The CFO weighing in on the results.
What we saw as the quarter continued into September,
we saw acceleration in our growth, which is what we had been hoping for and expecting, but it was good to see as we got into the strength of our schedule.
For more, let's bring in Bloomberg's Kelly Lyons. Hey, Kaylee.
Hey, John, well, subscribers is really what it's all about for Netflix. And with 4.38 million additions in the third quarter, they handily topped analyst expectations on that front. And they topped expectations on the guidance as well. They expect to add more than 8 million new customers in the fourth quarter of the year. And that really is due to the content slate, which they called, quote, unprecedented in terms of upcoming shows. The one show Netflix really has to thank, though, is Squid Game, the South Korean shock-oriented show that has taken the world by storm. I myself haven't seen it. I don't do well with gore, but a lot of other people have. 142 million households have watched at least one episode, which makes it the most popular show ever. And actually, when you look at Google searches, it peaked in terms of Squid Mania in October, which is already into the fourth quarter, which is why we may see some read-through into the final quarter of the year. The thing about it, though, John, is Netflix at the opening bell is off more than 2%, so not getting rewarded. And that may just tell us that expectations were really elevated going into the print. The stock is up 25% over the last 2 months. And actually, an analyst over at Deutsche Bank downgraded it today because they said all the good news in terms of subscribers for the fourth quarter is already priced in. My question is, with the NYSE FANG Plus Index back at a record, does that also set the bar really high for Apple, Amazon, the other big techs that have yet to report? And of course, Tesla is due after the bell today, John.
Are you going to watch it, Kelly Lyons?
I don't think so. I don't respond to peer pressure, John.
I'm going to take a miss as well. I don't even have an account on Netflix anymore, Kaylee. It's gone. Kelly Lyons, thank you. This is the lineup of the Ferro household right now for anyone that actually cares. Paramount Plus for the Italian football, Hulu for the live Premier League on the weekend, Peacock for the additional live Premier League football on the weekend, Amazon because it gets given to you with Amazon Prime, and that's it. It's just about sport through the weekend. Oh, and HBO Max for Succession, Kaylee. HBO Max for Succession. You in on that?
Absolutely.
Good. I'm pleased we agree on that too. There we go. That works. Bank of America recently publishing its monthly fund manager survey. Here's the big takeaways. The least bullish report in a year, with cash levels jumping to a 12-month high, inflation in China, pessimism fueling negative global growth expectations, with allocations to bonds hitting an all-time low and remaining very high to stocks. Phil Guarco, let's go here first. We talked about this briefly. The slowdown in China and why we wake up every single morning and no longer seem to care in this equity market. Phil, we've gone from worrying about China a lot for a very brief period of time to not caring at all. Why is that?
Well, I think the reason why we're not caring at all is because we click our heels and we find that we're back in the U.S. and things are going very well here, and they're going to continue to go well because balance sheets are great on individuals and small businesses. The issue with China is it's going to be drips and drabs, and I don't think anybody has really come out with a very good view of what the effect is going to be on that China on global growth. So I think for the moment, we're all ignoring it because it's hard to quantify and it's not an open economy, and the transmission method to global finance is just not there. So I think people are just enjoying the ride for now.
Jared, the data, Jared, just doesn't look good over there right now. Home price is negative for the first time in 6 years. We know how important the property industry is to the overall GDP profile of China, and yet here we are, seemingly just shaking it off. Jared, what do you make of that?
Well, John, our Chinese economists just massively downgraded their growth expectations for Chinese GDP over the next several years. They've gone from the sense that policymakers would step in, they would ease policy and sort of resume credit growth. And the view now, I think, is that those easing measures are not in the cards, right away. Regulatory relief not in the cards right away, and so China is likely to be a big drag on the global growth outlook. I think it's one of the least correctly priced risk in the market. I think it's a very serious source of concern, especially not just for people who own Chinese assets. We've argued this year that some of these are probably value traps at this point, but even for folks with heavy concentrations elsewhere in the world, even a U.S.-only investor actually have massive exposure now to the China growth outlook simply via owning multinational companies based in the United States. There's huge growth exposure to China, and that's one of the reasons why our equity strategists, our research analysts have broadly been looking for companies in the small and mid-cap space as likely relative beneficiaries. Large caps come under pressure from a slowing Chinese profile.
Jared, I saw the work of Savita and Jill on that, and I think it was really, really compelling. It was a great read, and I suggest for anyone that hasn't read it, reach out to the team over at B of A and have a read of it. Just building on that, Jared, that line that you just used, the least correctly priced issue in the market, one of. How should it be priced, Jared?
Well, it's a story about, you know, a 6% or 8% GDP kind of Chinese economy becoming something more like 3 or 4%. I mean, even Xi Jinping himself has you know, multiple times explained that there's two different kinds of growth in China. There's the credit-fueled, lower quality growth. There's the higher quality consumer-driven growth. They've obviously wanted to shift toward domestic consumption in China for a very long time. The problem is it's a very difficult thing to do. It's very challenging. Whether you have a sympathetic view or not doesn't matter. And so that's a difficult shift to make from a policy point of view. Our economists think that it's going to be, you know, take some real time even if it does succeed. And so the growth engine, the contribution to GDP that China has been may not be there. And so to the extent that companies have gotten involved, to the extent they have revenue in China or in related countries, it's going to be a big challenge. And so I think that's why our equity team is looking at small and mid caps more or less than large. I think it's also a reason why, from an asset allocation point of view, certainly over the next quarter or two, there may be a better profile for credit than for equities as some of the upside potential gets trimmed on slower Chinese growth.
Interesting. Just build on that, Jared, a little bit more. Where in credit? High yield spread still pretty tight, pretty well insulated by the energy story at the moment. Where in credit?
Well, we've done some analysis lately, and what we found is that if you look at the last 10 years of returns, total returns, across the credit market, you look at where yields are today, that ratio of current yield to long-term sort of downside risk is most attractive in places like floating rate debt, leveraged loans, high-yield corporates, even emerging market debt. Less so in the higher quality treasuries and investment grade. They can still see negative returns. Yields are so low today, you don't really get paid for taking that risk. And if you're of the view, as our economists, and we are, that there's more to go in this business cycle, more to go in this market cycle, then there's some reasonable credit risk that you can take, especially EM external debt. And I think the floating rate loan market is an attractive place to get a yield pickup that doesn't require, you know, consistent and steady, you know, earnings beats, especially in large caps, large cap tech, large cap China exposure that looks really challenged here.
Phil, you've been listening to this. Can I get a final word from you on it, please?
Yeah, I think one of the underappreciated risks about China, Jonathan, really has the housing crisis there raised geopolitical risks. And I think this is the tail risk that's extremely hard to quantify. In the sense is there a higher risk of sort of some diversionary event to divert the Chinese people to maybe, you know, Taiwan issues rather than so that they don't focus on really the extreme amounts of value that are going to be lost in housing. So that's the kind of unknown for me that makes me want to have at least some core bonds for what Priya was talking about in terms of liquidity.
Makes sense. Phil, thank you, sir. Phil Guarco, Jared Woodard, weighing in on all of this. Your market right now, about 9 minutes into the session, advancing about 0.1% and change, advancing almost 0.2% for a 6th day of gains potentially. Energy at the bottom of the pile, down 0.9%. Top of the pile is healthcare, utilities. You get the picture. A little bit defensive. Real estate up there too. Healthcare advancing a little bit more than 1%. Coming up on the program, China's housing market slump intensifying, fueling fresh warnings on Wall Street.
If the prices are going down, which they have been, I think that could really hurt consumer confidence.
That conversation still ahead. Plus, Joaquin Fowles joins us with PIMCO's newly released Secular Outlook. That is next on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
They know me as
as Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life, and I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for now, even 5 years, I think.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
People have said uninvestable.
China is uninvestable.
I wouldn't say it's completely uninvestable.
As soon as Jack Ma was banished, we started pulling back.
There's always going to be a certain amount of disruption.
I'm just saying, wow, they're playing with fire.
There are ways to play around the edges.
What I don't understand is they're going after real estate.
When we look at China, we're not focused on the consumer.
Margin is clearly not appreciated by the government anymore. Common prosperity.
We're trying to figure out the places where there's innovation.
Investors growing somewhat wary of opportunities in China amid an intensifying housing market slump. This coming as home prices fall for the first time in 6 years and another developer defaults on its debt. For more, Damien Sassower of Bloomberg Intelligence joins us now. So, Damien, you're the man in charge of telling us why the Chinese currency is getting stronger and not weaker. Go.
4 little figures, right? I really have no idea. 643 to 639 in just the last 36 hours. Pretty unbelievable. But, let's just focus on China property for 1 second. Land auction failures. Local governments that have to sell off these parcels every month, down 27% year over year. Slowest pace since 2018. And construction output down 1.8% year over year. I mean, Jonathan, yes, that's the slowest since the pandemic, but prior to that, you'd have to go back as far as 1992 in order to see such weakness. Yes, Kaisa, Evergrande. I mean, Evergrande, the 30-day grace period expires this weekend, so we're going to see what happens there. They did make payment on a yuan-denominated bond yesterday, a good sign, but the Hobson deal seems to have fallen through here. Kaisa, the third largest issuer of China property debt. We have a $36 million coupon payment due on Friday. Moody's just downgraded the company. Again, something to keep an eye out for. So a lot going on in the China property sector. And to your point, dollar yuan at 639. The fixing came in at 641. So Beijing's not really all that happy to see that appreciation in the local currency.
Stable to stronger. Bitcoin, just in a headline right now, rising to an all-time high, surpassing the April peak. That's one that's going to get talked about a little bit later. Just wanted to fit that headline in. Damien, I want to talk about this with you too. There was a Wall Street Journal piece out in the last 24 hours suggesting that there's some real pushback against President Xi's big push to have a property tax. What did you make of that?
Yeah, well, I mean, the last thing that country needs is a property tax, and this is what's going on in the sector. And so, look, I mean, I've read the same piece that you did. I think, look, you have to take kind of a step back, and you have to look at, what is China credit pricing in? I mean, the CDS 5-year sovereign spread, which had blown through 60, is now back below 50, which is a very good sign from the perspective of offshore creditors who need to insure against their offshore holdings. So, look, for me, it's going to be, as you rightly point out, dollar yuan, and the fact that it's appreciating in the face of all this, and the fact that China government bonds are now trading at an all-time high. I mean,
Unreal.
Go figure.
Damien, I'm trying to figure it out. Thank you, sir. Damien Sassow. We're all trying to figure it out. Bitcoin just having a nice breakout here through 66K briefly, up by 2.5%. How connected is this story to the rate story? I've got no idea. But on the rate story, PIMCO says this, expecting rates to remain lower for a whole lot longer. They say, quote, elevated debt levels and highly financialized economies will likely constrain the ability of central banks to push interest rates aggressively higher without causing severe economic pain. Joachim Faust joins us now on this, PIMCO's global economic advisor. Joachim, I want to start here. Do you think we've finally broken out of the low inflation regime that dominated the last 10 years?
Well, Jonathan, first of all, thanks for having me. I think we have broken out of what economists called the great moderation, or what we at PIMCO called the new normal of low but stable growth, below target inflation, and elevated asset prices. So I think that's clearly behind us. I think we're in a radically different environment. Whether we'll really see above target inflation for longer over the secular horizon, we have our doubts. Certainly inflation is likely to be higher on average than it was in the previous decade. But the key point is that both growth and inflation, I think, will be more uncertain, more volatile. And I think we're looking at fatter tails for inflation. So both the risk of higher inflation has risen, but also the risk of much lower inflation. And I think this is the part that markets often tend to forget about.
So, Joachim, how dependable then is the Fed put in this regime?
I think it is dependable if we see another major dislocation in markets and the economy. But we should not assume that the Fed steps in when there are wobbles in markets. So what we learned in the pandemic, if things get really bad, the Fed can do big things and unexpected things like intervening in the credit markets. But I think you would need to see a major shock to get that. Outside of that, in a more normal cyclical environment, I think the Fed will not step in immediately. I think they will reserve this for really major negative shocks.
So, Joachim, I think this outlook has huge implications for the bond market. And I'm sure internally you've discussed this. Joachim, if this is the outlook for you and the team now, what is the consequence for treasuries? The traditional role of treasuries in a broader portfolio, what are the consequences for that?
Right. I think two things to mention here. First of all, I think in this next, or in the current economic cycle, you're likely to see lower terminal policy rates. So it's unlikely that the Fed can put rates as high as they did back in 2018. Even then, when the Fed funds rate moved to the 2.25% to 2.5% range, bad things started to happen in financial markets. And the Fed had to walk back and cut rates 3 times back in 2019. So the first thing is the short end is likely to be anchored. So this will anchor yields across the curve. We may see some further steepening in the yield curve, but we think we'll continue to be in a relatively low range-bound environment for bond yields. Now, the second thing to consider is we learned last year that treasuries are still a good diversifier in otherwise risky portfolios. So given the backup in bond yields that we've seen since the fall of last year, there is a potential for yields to rally if bad things happen. Sorry, for bonds to rally, for yields to fall when bad things happen. So we would think that an allocation to core bonds still makes sense, even though the absolute level of yields is lower now than it has been historically.
Joachim, when I hear you say you think the front end is anchored, are you pushing back against current rate pricing?
I do. I think the Fed will be very patient. The Fed is focused on maximum employment. The Fed knows that markets have become very sensitive to even small changes in rates or in rate expectations. There's something like a financial market dominance that we talk about in our secular outlook. I think that constrains the Fed. And again, you know, we're still far away from maximum employment. That's why I would think that the Fed is unlikely to raise interest rates next year. We still think the most likely timing of the first rate hike, if and when it comes, is 2023 rather than 2022.
So much of that assessment, though, is dependent on how quickly the participation rate recovers and whether we can achieve the pre-pandemic goals, the pre-pandemic objective of getting back there. Joachim, when I read this outlook, it just feels like everything we look forward to next year and beyond, the range of outcomes is incredibly wide. You've walked us through the potential shape of this cycle. I want to understand the duration of this cycle from your standpoint. If the Fed is stuck between a rock and a hard place, can't go too much higher, can't drop from here either, what does it tell you about the duration of this cycle?
Yeah, so first of all, I think the macro environment has changed radically. There are three major transformations. That's why we talk about the age of transformation. There's the green transformation, the digital transformation, the social transformation. All of that brings with it a lot of policy changes and also pitfalls for policymakers. So the implication for the duration of the cycle is that we are likely to see shorter cycles. We're likely to see larger amplitudes. For example, the green transformation may bring an investment boom, and you could argue it has already started in renewable energy. The digital transformation has already led to much higher tech spending in the corporate sector since the start of the pandemic and a pickup in productivity growth. So there's a possibility of boom-bust cycles. There's a possibility of investment booms, but there's also the risk of stop-go fiscal policy. And so if you take it all together, economic cycles are likely to be shorter in duration, larger in amplitude, and they're going to be much more divergent across countries and regions because these transformations happen at very different speed in different countries.
This is a really important discussion, and Joachim, we need to spend more time on it. Stay close, it's been too long. Don't be a stranger. We need to catch up with PIMCO a little bit more often on all of this. The S&P up about 1/3 That was Joachim Faust of PIMCO weighing in on the outlook. Let's talk about the here and now with Dave Wilson, our stocks editor, on a sector price action. Hey, Dave.
Hey, John. You've got 10 of the 11 main industry groups in the S&P 500 higher in early trading. Energy, the lone exception. We're seeing crude oil prices fall at 1 point below $82 a barrel in New York trading. That's weighing on the group. In terms of leadership, though, you're looking at defensive areas of the market. Healthcare, utilities, consumer staples, food, beverage, tobacco, real estate. They're the ones at the forefront of the gains. A lot of the other groups barely higher, less than 1/10%. Want to take a closer look at healthcare, though, because if you go through individual stocks, you see Anthem as the best performer on the day in the S&P 500. The health insurer out with earnings, and Anthem's peers are rising as well. Centene, Cigna, Humana, United Health. We also had figures out of Abbott Labs and Biogen, and they went over well, too. And when you look at this healthcare group, you see that the S&P 500 healthcare index set a record at the beginning of September. It's pulled back a bit, and now it's making another attempt to get back to that high.
Dave, thank you. As always, our stocks editor on top of the price action through the day on Bloomberg TV and radio. Coming up, the market moving events you need to be watching for. Your trading diary is up next. From New York City, this is Bloomberg.
Talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
A sixth day of gains potentially here, the longest winning streak going back to early July of this year. We're up about 0.25% on the S&P. Very defensive, though, led by utilities, consumer staples, healthcare, and the likes, including real estate, too. So a small day of gains on the card. That's the price action. Let's get you the trading diary. What you need to be watching for through the rest of this week. A loaded slate of Fed speak with Presidents Evans, Bostic, Kashkari, Bullard, all coming up at 12 p.m., followed by Governor Randy Quayle's at 1 p.m. Eastern. The Fed's Beige Book coming up at 2 p.m. Governor Waller and President Williams on the docket for Thursday. We round out the week with Chairman Powell's policy panel this Friday. Looking forward to all of that. I am, genuinely. From New York City, thanks for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
At the low point of the Greek economic debacle, what were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms, and I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
Do you consider yourself a filmmaker, a historian, an educator?
Well, you know, the biggest thing is that I'm a filmmaker, and that means I tell stories. And the way a painter might choose to work in oil as opposed to watercolors, I choose to work in history.
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and like what changes they are actually bring to this market.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo.
Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay. In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into